8:32.
Yeah.
That's what I thought, yeah. Okay, and would Leland, would you lead us in the Pledge of Allegiance?
Pledge allegiance
To the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Is there any public expression this morning? No public expression. We'll go forward to the consent agenda. Does anyone have any comments, modifications, changes to the minutes? Has everyone had an opportunity to read the minutes? Okay. The retirement report, any comments on that? Preliminary monthly financial report? Okay.
I appreciated Stan's narrative.
Appreciated what?
The Stan's narrative.
The Stan's narrative, okay. Would you like to, you just reading it, not
Yeah.
him talking, okay. And the trustee education and training annual report? Okay, so, moving on to regarding investment matters and the Callan firm update.
Great. Greg and Claire, all right, you guys are up.
Is Richard coming?
As far as we know.
Do we want to do one of these chairs? Okay.
Excuse me. Hi, Julie.
Hi.
I don't know if we met.
No.
My name's Greg.
Hi, nice to meet you.
It's nice to meet you.
Hi, Claire. Nice to meet you.
Welcome to the board. So, I brought my handouts here. I'll get to you later. We had 4 things we wanted to talk about today. One is about an investment philosophy statement, so we'll get to that. We also have our standard quarterly review. We have our Callan's annual capital market update. And then we have a section that's an overview of Callan. And we thought we'd start off with that part. And first, thanks for retaining Callan. I know at the last meeting it was a vigorous debate as to whether or not you should retain Callan. And we appreciate the confidence that you showed in us. We've very much enjoyed working with you over the last 9 years, and we look forward to working with you going forward. Okay, so we have the attachment here. I don't know what it's called.
This is investment beliefs discussion?
No, so I was going to flip
Sorry,
into
capital
the,
markets outlook.
yeah, so it just starts with this, Mendocino County Employees Retirement
Summary
System.
presentation.
Summary presentation.
Or summary performance presentation.
Let's see if I have them. We call them investment beliefs, capital markets.
So it's in the front of the capital markets
overview,
outlook. So hit the 2019 capital market outlook. Okay. So did everyone pull that up? 2019 capital market update?
Yep.
Okay. So what we thought we'd start off doing is, I know there's a lot of debate about Callan and Callan's business model. So we thought we'd just address the elephant in the room as we got going to make sure that we're all on the same page. So we're going to start off flipping off with that. And if you move to page 2, here's some information about Callan, which should sound similar to what we talked about at the finals presentation. We were here for about 30 minutes and walked through the firm and how we work with you and what we're going to do with you going forward. And this is some of this information in the presentation that we shared with you at the time. A few key takeaways from slide 2 is that Callan remains a 100% employee-owned firm. We manage about 2.3 trillion in assets, and we've been doing this for about 45 years. So a lot of experience working with investors like yourself. We're independent and we're employee-owned, and we think that's a good thing because it helps us retain employees, and we can set our own course going forward. Some other firms are no longer employee-owned, and we think this is a strategic advantage for us. Flipping ahead to page 3, what we want to do at Callan is create a firm that marries the benefits of a large firm, which means we have a lot of resources. So you have a question about trust and custody, asset liability studies, manager research. We have people who can answer questions about that. But also a small firm touch where you know Claire and I, you know our names, we're here all the time. And so it's a client service function where you get to know us and we really know you as an investor. It's hard to marry those two things together because frankly it's expensive to have the resources and to keep people like Claire employed. So how do consulting companies do that? They have a few different business models where they have enough resources to retain people and have resources that you demand. You need those resources to be good fiduciaries, okay? So a few different consulting firms answer this question a few different ways. The way Callan answers it, before getting there on page 4, just to note that we work with about 65 other public entities like yourself at 1.5 trillion in assets. So there are a lot of other investors like you who we work with. So how does Callan answer that question on page 5? We do so by having a diversified business model. We have a number of different types of investors that we work with. And if you see on this pie chart here, about 75% of the revenue that comes to Callan comes from asset owners like yourself. And that's either in a discretionary or non-discretionary framework. So 3 out of every $4 comes from people like you sitting around this table. Okay. We have another 10% which comes from a group that we call the Independent Advisory Group. This is a different group within Callan. This is not me. This is a whole team of other people. And what they do is they sell research and support to smaller consulting firms. Firms who work with smaller investors who don't have the resources Callan does, but we provide back office support for them, research support for them. And these are other advisors who don't really fish in our pond. You know, they're too small to deal with Mendocino County. They might have a $50 million client or something like that. So then we don't see any, we don't have a problem helping them because they're not competing with us, right? So that's about 10% of our revenue. And then we have 14% of our revenue which you all had a vigorous debate about, right? So 14% of our revenue comes from a group we call Institutional Consulting Group. Again, this is not the group I operate within. It's a different group within Callan. But we provide services to investment managers. They are clients of ours. We have about 190 asset manager clients, both active managers and passive managers. And they represent about $49 trillion in assets. If you think about those numbers, this is a huge component of the institutional marketplace. Finds value in the research, performance analytics that we produce and actually provide you as well. So these performance reports that we produce for you, some asset managers find value in knowing how does their product rank within a database. What do the characteristics of their product look relative to others? They find value in that. They find value in things like Callan College, where Catherine and Lee, I know you both attended last year. You all find value in it, and they do too. So do we make them pay to attend? We sure do. Just like you pay to attend. You pay us about $175,000 a year in the new contract. The average asset manager in this group pays us $30,000 to $60,000 a year. So putting that in perspective, whose interest am I more aligned with, or the firm's interest more aligned with? Is it with you, who's 75% of our revenue and pays us 3 to 6 times the amount of money per relationship? So clearly, it's you. But we do recognize that there is an opportunity for us to sell the central research like this to other people. And why is that a benefit to you? Well, I talked about how do other companies provide resources and delivery. They might do other things too. They might push people towards discretionary consulting. They might be a subsidiary of another entity that sells actuarial services, and they might be interested in cross-selling to you. They might just charge you a higher fee. But in the consulting industry, we're all faced with the same dynamics of how do you have resources like Claire provide the services you do for roughly all the same amount of compensation. So this is the way Callan has solved the problem and the challenge, and we've done so for 45 years. I would contend that every advisor you talk to has a conflict of interest. The question is, do they disclose it to you? And do they manage it properly? I don't think.
Yes.
So on disclosure, when we recently interviewed 3 consultants that you guys brought forward for advising
Asset managers?
Asset managers for international investments.
Yeah.
And I only learned after the meeting that 2 of the 3 were among the group that are paying Callan.
We're clients of Callan.
Clients of Callan.
Yeah.
And you didn't disclose that in the meeting. And it would have been, I think, just, I think you guys should have had the confidence to say, hey guys, you guys know us, you trust us. You're going to interview 3 people today, and 2 of the 3 are clients of ours. But that has no bearing on why we brought forward these 3. But you didn't disclose it to us in the meeting. And then when someone in the room asked, do you have any preference? You didn't say you had a preference, but you said, well, I'd probably focus on these 2. It just so happens that those 2 were the 2 who were your clients. So I think in terms of transparency, I think going forward, I'd really appreciate if you, anytime you're bringing forward, a list of consultants for us to consider that you would disclose to us, if any of them are Callan clients. So we have multiple disclosures, and on page 6 we talk about our disclosure policy. The back of this performance report. But I don't think putting it in the back of a report is sufficient. You can verbally say that when you're introducing consultants.
Well, let's talk about that a little bit. So we have the disclosure here. We also produce a due diligence report for that search. And in that report, it listed whether or not those managers were clients of ours. Now, you may not have read the full report or seen it. I think that's fair. Now, when you're interviewing these managers, we have a written report that tells you whether or not they're Callan clients. But if I verbally tell you that during the interview, and I'll be glad to do it going forward, but is that going to influence you one way or the other as you make your decision about who you want to pick? We have procedures at Callan that have already vetted out to make sure potential conflicts don't lead to the group we recommend to you. We've managed that conflict internally. If I tell you that verbally, right before people walk in the door, does that affect your decision on who to pick? And is that a good or a bad thing? I'm glad to do it verbally. Going forward, I don't know if it achieves the objective you're looking for.
I think it would, because I think we would then, everybody in the room has their own filters, and they would decide whether or not anything you say to us in reference to the three had any bearing on your comments. Each of us, again, have our own interpretation of ethical standards, and I think that's why we have a diverse board.
Well, if it's the will of the board, I'd be glad to verbally disclose that for any other search we ever do, but to be clear, it was disclosed and written material provided to you. So I'd be glad to do it.
Is this an appropriate time to
For a
ask?
motion?
No, to ask questions? So after I voted basically against Callan just
Right.
because of pay to play, and then I went to your conference, and excellent conference.
Yep.
And thank you, Greg, you treated me just like I was your biggest cheerleader.
That's great.
And I asked, I said I have a very personal fiduciary responsibility when I'm presented with something that's pay to play, because we made such concrete decisions in CalSTRS.
Yep.
And you said to me, well, basically our clients, those who pay, are the ones in the room, was what you said.
The asset manager clients of Callan were in that conference you were at.
Yes, and the
Yes.
pay for the conference was the way they pay.
As one of the services they provide is to be able to get our education and research. The conferences, Callan College, as well as performance analytics, if they choose to pay for that. PEP software, which James just purchased in the contract, they could acquire that as well.
Okay. So when I was writing my report the other day, I went back through the agenda, and I've gone to a lot of conferences over my
Yep.
CalSTRS years and here, and in your write-up, it describes the attendees, basically.
Yeah.
I didn't see any board members listed there
At the Callan,
at the Callan conference. Basically, I saw, it looked like various groups that were part, that paid to go there. That to me is a little unusual, or was I not?
I don't know what you were looking at, Sherry, but if you looked at the attendee list,
Yeah,
you
The
would
one in
have
the
obviously
printed.
seen, did you see your name?
no, I didn't. And I didn't see Richards, and we were the two that were there, so. Mine could have been because I was late getting in there, but Richard wasn't late signing up.
Maybe, shall we, no, we just have the attendee list, and a lot of people use the app. And I could scroll through the app and I would see like who the attendees are, and you would have seen Alaska Retirement Management Board, the Public Employee Retirement Association of Idaho, Utah.
I guess I was looking for board members, and maybe, that it specifically said
This person is a
board
board
member,
Mm.
yes.
So what I again, I don't know what you're looking at, but what we generally have is the name of the person and the organization of where they work. And you would have seen a lot of asset owners, like you,
Mhm.
as well as asset managers listed. And also I mentioned that IAG group,
Mhm.
we have other IAG members there as well. So I don't know what you're looking at, Sherry, but
Okay, I would have to go check back at home, but
yeah.
anyway, I just thought it was odd, and I wondered how people are differentiated when they go to your conferences, since that conference is something that you said to me was, well, this is how, people buy or pay to go.
Well, it's one of the services is that, I mentioned it might be software, it might be performance, it might be research papers, it might be to attend our conference. And the asset managers might pay for any number of those things. So one thing I think about is, okay, we have this conference, we have these, Condoleezza Rice come and speak.
It was excellent, by the way.
Well, thank you. And you want to be there, other people are there too, and of course we make them pay.
Right.
Right, because you pay me $175,000 a year. Why would I not charge someone else to attend that?
Yeah.
Otherwise, you're paying the bill, right?
Yeah.
Now, you said pay to play.
Yes, that's my
And-
issue.
Oh, right. So I want to be careful with language
Mhm.
because that's a loaded term. That implies a quid quo pro.
Yes.
I will pay you money to get this, to
Yes.
play. And that is not what's going on at Callan. They are clients of ours. They pay for that service. That's what they get.
Mhm.
End of story. There's no play involved after that.
And I really appreciate that clarification.
Yeah, so if we have, in this list, there's 200 firms here. How could there be pay to play with 200 firms? Like, functionally, how would this group somehow benefit 200 asset managers? Right? So there is no quid quo pro, pay to play. Callan has investment manager clients, and we have asset owner clients, and we have clients who are intermediaries. That is clear. We're very open and transparent about it. One of the things we believe in strongly is that, okay, if you operate in this industry, you better look hard at yourself. And it's easier for you to talk about the speck in someone else's eye when you remove the log in your own. Right? So, we look hard at the log in our eye. And we try not to talk about the speck in others' eyes. So how do we look at the log in our eye? Well, we go through page 6. And so annually, we go through our code of ethical responsibility. Every member of Callan has to sign this and attest to following a code. There's actually been research that's shown that if you make people attest to being ethical and sign something periodically, the occurrence of them being unethical collapses. We have a compliance monitoring procedures. We have a chief compliance officer who reports directly to our board. James and Stan had the opportunity to sit down with our chief compliance officer, Ann DeLuce, and our chairman, Ron Payton, when they came into the on-sites. So ample opportunity to ask questions at that time. We have separation of business units. I mentioned that we have these 3 distinct client types. They're all handled by different people. I do not service third-party intermediaries. I do not service our institutional consulting group client products. I'm in the fund sponsor consulting group. And those are the people I work with, so we have separation of business units. We have a peer review committee process, and we think that's important and a bit of a differentiator at Callan, because conflicts are subtle. And if you just know someone personally, you might have a conflict. If you worked with someone previously somewhere else, you might have a subtle conflict. So how do you vet that out? You have a group of your peers analyze every investment recommendation you make to an asset owner client. And that's something we do. When it comes to asset allocation, we have a client policy review committee that vets every asset allocation recommendation we make to you. And then when it comes to investment managers, we have a manager search committee, which I happen to be the co-chair of. So it's actually my job to vet the searches that go to clients at Callan. It's every Monday morning, and we were joking about it driving up today. So we have the peer review process, and then the final thing is disclosure. So we want to proactively disclose to you that we have these other business relationships. We don't try to hide it. We tell you exactly every client, asset manager client that works with Callan. And we don't diminish it. And you interviewed 4 providers, 3 of whom have some sort of relationship with some sort of service provider you might hire. We say, okay, we recognize it. I'm going to disclose it to you, and I'm going to tell you. What the other 2 firms do, I don't know. And then the 4th firm you interviewed actually just went through a merger. So they're managing a consulting firm is hard for the 2 things I talked about earlier: resources and client service. And a lot of firms are trying to figure out ways to figure that out: mergers, acquisitions, increasing scale, or having a diversified business and being stable. So I'm going to flip ahead to page 9.
Great.
Yeah.
I have several questions, and one of these I pre-warned you about, but before getting to the question I warned you about, I want to back up a little bit. It's important that we all recognize the advice that we're getting from our investment consultant. And one of the key roles that the consultant plays is as a gatekeeper. The only firms that get in front of this board to make a pitch at a finals presentation have to come through you. Would you agree with that?
Well, historically, that's been the case. Some clients choose to have RFP process, and there are different ways you can manage how you do a manager search, but to date, what seems to have been most efficient for you is to ask us to create a short list of managers for you to interview.
Yeah.
Yeah.
So, even if you do an RFP, I've done RFPs for investment management, you're still relying on the consultant, and they're acting largely as a gatekeeper. Very few we're just not at a scale, and even with a much larger organization than us, you're not at a scale to manage an RFP internally unless you've got a large investment staff. So the consultant acts as a gatekeeper for a lot of firms. CalPERS, CalSTRS, they can run their own RFPs because they have such large investment staffs.
Right.
It's just important that we understand that role of the investment consulting services. And I think that in part leads to a little bit of the tension, your role as a gatekeeper.
Yeah, so said differently, just I give you recommendations on asset managers.
Right.
Right. And whether you should retain someone you currently have or whether you should hire someone else. I give you recommendations on asset managers.
Yes.
Yep.
Distinction without a difference there. So I just wanted to put that out and make sure
Yep.
we're all aware of that. I mean, because that's, to me, that's one of the central issues here. The related to that is also the advice we get from you in terms of asset allocation and how to allocate our resources, our investment pool into various spaces, and also what types of managers we're going to use versus in terms of active versus passive. And personally, there are times where we've gotten advice, and the question is in my mind, is this the best advice for us, or is this good advice, maybe tweaked because of the disclosure list? And I'll go back to large cap, I can't remember if it was value or growth, where we had two active managers and we trimmed to one. And it
You used
was,
to have 2 value and 2 growth, and we
Right.
got rid of 1 of each and introduced passive.
there was Boston Partners and
Dodge and Cox.
Dodge and Cox.
Yeah.
And Dodge and Cox is not on your disclosure list, but Boston Partners is. And we kept Boston Partners. There's just a question in my mind. Not saying it was the wrong advice or that Dodge and Cox would have been better. Just telling you, there was a question in my mind.
So if you ever have that
Overnight.
question, you could always ask it.
That's
Right.
a good, yes.
Yeah,
That's
but on
excellent.
top of that, you can ask it, and every recommendation we give to you is not done without a basis for the recommendation.
Right.
So we have a search due diligence report that shows you all the characteristics of any manager we ever recommend to you. More detail than you probably want. And on top of that, when Callan did the manager structure, we recommended a higher allocation to passive than this board wanted. So if you actually followed our recommendation, you would have gotten rid of all 4 of the managers. Right? So
Right.
it's not that we kept 2 that we had a business relationship with, we wanted to fire all 4. But you all liked the historic performance of your active managers, and they've done well. So you might ask, well, what was the basis for your recommendation about active versus passive? And you recall that we walked you through these rolling charts that show the persistence of active management alpha in different scenarios. And we said, based on this data, we are making a recommendation. And we think you should be passive in large cap, active in small cap. We've demonstrated that fixed income is an area where you add value. International equity. Your international equity composite has been disappointing, but the average manager has done better. So our recommendation was to fire all 4. You said, we don't want to fire all 4, which ones do we keep? And we looked at the pros and cons and decided Dodge and Cox, their performance was less consistent, frankly, than Robeco's performance.
And I throw that out there as an example of the kinds of, the questions that come to my mind.
Right. So if I were
and
you,
I
I
will-
would ask the question and say, what's the basis for your recommendation?
I haven't always been good about asking the question.
Right.
I'll
Yeah,
say that to the board right
right,
now. And we'll get better at that.
okay.
I do have one more, if I can finish.
Yeah.
The disclosure question. So the research by Dan Ariely and others showing that disclosure of a conflict of interest actually harms the client more than non-disclosure. how would you respond to that?
Well, Dan Ariely spoke at our conference a few years ago. So that thing where asset managers in part pay, he came and talked to our conference about conflicts and about design architecture, something we're very interested in hearing his research on, how participants in 401k plans react due to design architecture. So, one other thing that his research has shown, and I kind of alluded to it before, is the signing of the attestation to being ethical. That was actually research he did with his MIT students. So we certainly adopt that. But I don't understand the flip side of the argument. Should we not disclose? Should I not tell you that there's a potential conflict? His argument is that if I tell you there's a conflict, I am now free to run all over you. But that means that you're an uninformed board that doesn't look at research and isn't independent. I don't think that's true. So for you to believe that if I disclose this and now I can act evil, unfettered, I think is actually belittling to yourselves. Because you look at the research and the basis for our recommendations, and then you make the call at the end of the day. It's not me putting the manager in. And I think that's just a different situation. If I had discretion and was doing it on my own, I think you could make that argument. I think his research was it based on medical doctor recommendations?
Well, he's got some in that space, but he's also, I mean, they did an experiment with investment consulting where it was, well, it was choose a number between 1 and 20 was the basis of the experiment. And there was an advisor and an advisee. And the closer the advisee chose to the actual number, and it was a random number generator thing, the better the outcome for the client. So the natural advice is from the advisor is choose 10. It's the mean. It should be the natural choice. When conflicts were introduced, so it was a 3-step experiment. The base case, choose 10. Then there was a conflict introduced where the advisor got more compensation the higher the number the advisee chose. And the average went from 10 to 12. And then the third step was disclosing the conflict of interest. And at that point, the advisor, by disclosing it, felt licensed to advise whatever they want, so they advised much higher numbers, and the average went from 12 with a non-disclosed conflict to something like 13 or 14 with a disclosed conflict. So it was the advisor no longer felt internally bound by their own limits of what's reasonable and what's right. They had license, they could go all the way out on the spectrum. It was up to the advisee to discount the advice given by the advisor, and the experimental evidence showed that the advisee did not sufficiently discount that advice.
Was there a penalty to the advisor if they got
No.
caught in doing something wrong?
No. Yeah, I think it was if I
So
remember, it was
there's also been
I don't know if it was a
done
repeated
in the-
experiment with the same individuals or if it was one shot.
There's also been research done in loss aversion of where if I do something bad and I lose a client, that is 2 times more painful to me than if I get a client. So if you engage in behavior which leads to the loss of something, you cognitively know that it's 2 times more painful than if you get it. So what that study might be lacking is a real-world application that if you have a 45-year-old business franchise that is based, and you're a shareholder, and it's based on your reputation, and if you do something unethical that destroys it, is that really in your favor? As opposed to something, you know, if I give you advice and make an extra $20 versus $10. I think the real world application might be a little different.
Okay. Okay.
Aside from how many fairies dance in the head of a pin, you know, I remember when I got my real estate license 45 years ago, one of the things we were told you could enter into a real estate contract on the back of a book of matches. You needed 3 things to do. And now it's a stack of paperwork this thick. And back 45 days ago, ethical, beneficial transactions were conducted every day, every night, just like they are now. But now we have all this paperwork about a bunch of people just cogitating about fantasy conflicts of interest. Greg, I have sat in your chair right there as an asset manager with boards asking the same kinds of questions. And I came away absolutely delighted that they did, because it gave me an opportunity to allay these boogeymen things that people come up with, which are just, you know, ridiculous to me. But not ridiculous. They're valid, but they're not really valid in the real world. We hire someone like Greg because we trust him. He's doing a good job for us. He's the best guy for the job. He's got a long track record, and we get services. And I remember sitting in boards and asking, well, gee, why do you hire the same appraisers all the time? Why do you hire the same environmental consultants? Why do you go to the same title companies? Because they do the best work. You know, not because they do what I want them to do, or they do, you know, an appraiser will do one way or another. It's because they're the best appraisers. And I want the best appraisers because of my valued relationship with the board that I represent, not for me. Because like you say, it's more than twice as painful to lose a client. So anyway, it's time to buckle down and realize that we have a valued relationship, and to appreciate that relationship for what it is. And I thank you.
Thank you.
Jerry, to kind of explain my concerns on pay to play, and I very
Please
much
don't
value
use that
it.
word again. That's fraud.
It
That's
may-
like saying the man.
It's
conducting-
not.
It's like payola or kickbacks. It's a loaded word. It's a bad word, and it should not be said in this
It's
context.
not a bad word if you sat as chair of one of the 2 big pension funds and you saw the other one be so deeply involved in pay to play at the top level of investment. So decent people do bad things. And that was definitely pay to play. So that's
Pay to
my-
play has existed, and there have been people who have gone to jail
Yes,
for doing so.
and are in
I would
jail
just
now.
contend that
Yeah,
it's not what we're doing.
no,
But
it's not.
Jerry, I like you personally, and you
Likewise.
can use that word, and I won't take it personally.
Thank you, Greg. I do appreciate
Right.
it, and,
Yeah.
yeah, back at you.
Okay.
To the, so the board knows that, you know, I'm not a fan of Callan's business model. Theirs is not the worst out there, in my opinion. Okay?
Yay.
You don't sweat much for a fat girl.
You guys know where I am.
Are you left-handed?
Of course.
You just gave him a left-handed.
I have seen a number of consultants out there. And one of the alternate business models out there, Greg mentioned it very much in passing, is, we're going to be your consultant, but we're going to recommend or push you towards discretionary. Or we're going to recommend that you move into a new asset category such as private equity, and we will advise you in private equity for additional fees. I have seen that up close and personal with funds where I sat on the board. There was one firm that submitted a response to our RFP that had that business model. They didn't make the short list because that to me is far worse than what Callan does. They're above board. They disclose everything, and your response to the disclosure thing, I think it is a very valid point. In a repeated game, the incentives change very dramatically. So I will accept that answer.
Now we're all happy and good, let's make a bunch of money.
Well, we won't look at fourth quarter performance.
Unfortunately.
So it could be a whole lot worse, is my point. I mean, the ideal is you only have a single source of income and it's all from the investment, from our side of the fence. But that comes at a cost. And like Greg said, the resource limitations from that, we either have to pay higher fees to make up for that lost revenue, or we're going to get less services. There's no free lunch in this world is what it amounts to. So.
Right, or there might, that firm might go through mergers and acquisitions.
Right.
And the people sitting in front of you will change.
Yeah.
Or people might not be giving you complete disclosure about business relationships they have. And that's the one that irritates me the most. We're very open and upfront about it. And if you have incomplete disclosure, we think that's an error. So, I am glad we're still your advisor, and I'm thankful for you retaining us. I think it's very good that we're having this conversation, and that we kind of clear the air, if you will, make sure that you know exactly what we do. I hear what you are saying, and I want you to be comfortable with Callan, the organization, and the recommendations we make to you. We just signed an additional contract with you in which we note that we are a fiduciary, and we take that responsibility seriously. In being a fiduciary, we put the interests of the beneficiaries above our own interest, and we are assigned acknowledging that, being a fiduciary. Okay? And that's what you should ask all of your service providers to do. Do you have any other questions about Callan or what we do or how we go about doing it? Okay.
Good.
Every once in a while, families need to clear the air.
Isn't that true?
All right. So I think the next.
Go ahead.
What's that?
Nothing.
The next thing we had is the capital. Oh, do you want to do philosophy next? Okay.
Yes.
Let's do philosophy because that'll do the hard stuff in the beginning. So I have I'm sure you have an electronic copy, but I thought it might be helpful for you to just have a paper copy as well if you want to scribble notes on it.
So I thought all of it was very clear and I liked it. I thought the fifth paragraph was, to me, confusing. And I don't know if anybody else thought the fifth paragraph was a little confusing.
In this?
Yeah.
Yeah. Okay. So, in talking to Stan and James several months ago, the idea of writing an investment philosophy came up. And a number of other public funds have gone through this exercise over the last year or two. And I actually work with some endowments and foundations who have gone through a similar exercise. And what it's meant to do is to set up just overall philosophical beliefs about investing and managing of assets, which then helps you make decisions about actual implementation going forward. When we put this document together, it wasn't meant to be descriptive about saying exactly what you need to do because of each philosophy. It's more setting up, we believe this, we believe this. And other things in your investment policy statement, asset liability studies, manager selection, it's all, therefore we do this, right? So this is more, we believe this, and in other statements you say, therefore we do this. So some of these statements might feel a little hanging at the end. Okay, I say this, therefore what should I go do? The way this one is currently written, all of the therefore we should go do is answered in other documents or other standards. So in writing this, I did take a look at some other organizations that have written philosophy statements. I included ones that I think are pertinent to you. I excluded others that I don't think are as pertinent to you. We also included statements that Callan has written in the past for other clients. So we looked at a few different sources to come up with something that we think generally fits your philosophy well. We have this, and I don't know the best way to walk through this, if we should go bullet point, or if you've already reviewed, it sounds like Dan already pointed out topic 5. We could just move to that. So I'll kind of defer to you. Do you want us to walk through each bullet point and see if there's consensus there, or do you want to kind of open it up to more of a Q&A format?
What's the pleasure of the board? How many prefer the first option, or how many prefer the second option? Do you want to have a discussion about it or take a vote?
Yeah, let Dan ask his question on the 5th paragraph.
Yeah, I don't know, to me, it was all pretty understandable, except paragraph 5 was confusing, and I thought, if we're saying this is a clear statement of the board, we should all know what it means.
Yes, absolutely. Okay, so I'll read it aloud. Over the long term, equity and equity-associated investments will offer a risk premium over low risk and risk-free assets. Other risk premia exist, which may lead to a strategic overweight relative to a typical market cap weighted index. That's getting a little jargony, I'll admit. Examples of risk premia include small companies versus large companies, emerging economies versus developed economies, credit versus government securities, illiquid versus liquid assets. So maybe we could split this up into 2 sections, which might make it more clear. The first section is, we think equity wins in the long run. So why aren't you all in fixed income?
Because we don't have to be.
You don't have to be, because you have a long time horizon. But also we think equities will beat bonds in the long
Yeah.
run.
Debt's cheaper than equity.
Debt, yes.
Europe.
Yep. So over the long term, equity and equity associated investments, so that means real estate or something like that, without listing every asset category, will offer a risk premium over low risk, risk-free assets. So it means stocks will beat bonds
Yeah.
in the long run. That's what the intention is.
And they're more risky.
And they are more risky.
As a treasury pool, it has to all be in fixed income. You have to be there. This, yeah,
This is different.
yes.
Right. So why are you taking any investment risk at all? Well, we think we'll be paid for it over the long run, over bonds. Okay, so I think it'll be better if this is its own distinct statement. And then we'll put another statement. So what we're saying is there's an equity risk premium. Okay. And now we're saying other risk premia exist.
Among which are?
Among other, so small cap stocks versus large cap stocks. So you own a little bit more small cap than large cap.
Long-term versus short-term.
And emerging market equities versus international equities, there's a risk, you will be compensated for taking that risk. And then corporate bonds, so credit versus government securities. The Barclays aggregate index, the index you choose, has mortgages and corporates. Why not just all treasuries? Well, we think those corporate bonds will pay you in the long run relative to treasuries. And then illiquid versus liquid assets. This is something that you can argue there's a premium in investing in securities that aren't transacted daily. The market, if it's efficient, will demand a higher return from securities that are less liquid. Now, historically, you haven't invested much of your assets in illiquid property, illiquid asset categories, the exception being real estate, where you can't buy and sell that daily. But we do think that you must be paid a premium to invest in securities like that. And so that's where the liquid versus illiquid assets come in. Okay. So Dan, I think that's a long way of explaining what I tried to make this say, but clearly if you sit and read it, it's not evident, right? So maybe we should break up to 2 points. Is the strategic overweight, which may lead to a strategic overweight relative. So maybe,
Yes.
Hey, Greg?
yeah,
If my takeaway from Dan's comment is this is clearly written by an investment professional
yeah,
and it's heavy on the jargon.
yeah.
So maybe we want to take a crack at rewriting some of this with a whole lot less jargon. It's
Yeah.
kind of my thought.
And I only thought that way about the one paragraph.
Right.
And it was the
Yeah.
last 2 sentences of that paragraph.
Right.
Yeah.
A standard deviation is a useful, yet incomplete.
But that's
measure
just,
of risk.
that's an
That's a
overarching
standard,
kind of
yeah.
comment. We may want to think about
That's
that.
important.
Yeah, yeah,
Simplify this as much as we can.
yeah. Okay.
And that's, I'm extrapolating from the one board member's comment on one paragraph here.
Right.
And I don't want to jump out ahead of the whole board unless,
You're right on.
okay.
One other quick comment. Our portfolio is relatively high risk.
Yes.
I was very comfortable with that for 3 years. Just as a statement, I'm a little less comfortable about it as we go forward.
Yep.
Yes.
So personally, I'm looking for beliefs that are going to engage this board in making some decisions that might lower our risk profile, even though it means we are going to have an assumption that could be at a lower position, which means that our unfunded is going to look worse. So that's just a personal belief. I don't see how going forward we're going to be able to do as well as Callan has done for us over a lot of years.
Oh, gee.
To Jerry's point there, as I think about this, Greg, one thing that I think may be missing here, and it just occurs to me as she asked the question is, should there be anything in the philosophy or the investment beliefs about our target rate of return? Or is, I know we have something in the investment policy statement to that effect. Does that belong in beliefs or does it belong in the policy?
So I guess if it's in the philosophy, I could see it saying something like, we should achieve to make our expected rate of return on assets.
That's not really a belief, though.
No, that's an objective.
Yeah.
Right? Or, it's not really a belief. Other than that, it's in the policy statement.
Right.
How are we gonna make this target? So I
Right.
don't know if it's.
I
don't know
think
if
you're
it's
right.
in there.
It was a question that occurred to me,
Yeah.
and I threw it out.
Yeah.
So, but that's, so if I can back up, the whole point of today's discussion on this was not to finalize a belief statement, but to start the dialogue. And what does the board believe? What do you want to see in the belief statement? What do you not want to see in there? Those kinds of discussion topics. It's not, here's your belief statement, adopt it. It's much more of a discussion today. So.
So, Jerry, there are two areas where we talked about volatility having an impact. So what you're getting at is, yeah, we've reached for a return because we have a expected return on assets we need to achieve. But the path of returns can impact your solvency. And that's really speaking to volatility. So the third one, the third bullet point kind of alludes to it in the second sentence. Asset allocation decisions should balance the benefit of long-term growth provided by the capital markets with the ability to weather short-term drawdowns due to capital market volatility. So what that's trying to say is we'll benefit from the capital market, but an asset allocation has to be prudent enough that we can weather the storm to get to the end. And then 1, 2, 3, 4, 5, 6, 7, 8.
Yeah.
High volatility at the total plan level can impact contribution rates.
Yeah.
Negative equity markets, which impact market values, will at times be correlated with slow economic growth, which may impact the ability of the sponsor to make contributions. And to me, that was 2008, right?
Yeah.
Where
Yeah.
we had a major drawdown, the desire for contributions was there, and at the same time, there's economic stagnation, and the ability to make contributions is not there. And to me, that's the hardest thing about asset allocation. We say that, we're long-term investors, we can stomach the volatility, but if there's a correlation of needing contribution and the ability to make a contribution, then we need to be mindful about that. We can't be 100% stocks. So then what's the right mix? So in the coming months, we'll do an asset liability study, and that's where we'll test some of those things. Okay, where's your pain point? Where's the point where we say, okay, if this scenario occurred, it's unacceptable. So that'll be during the asset liability study.
The second paragraph from the bottom talks about active and passive management. And I tend to believe that in the equity space, we need to rely upon managers who know the market every day, in and out. But I also think I'd like to see as a somewhere in this that we believe in supporting our community, and that if an opportunity should arise, that we would be open to consider that and to apply our own active management in doing so. And I keep using this as an example, if we had an opportunity to finance student housing, leased to the college, a real investment grade, safe investment for us, then I would like to see in our philosophy statement, or the stone, the ability to say, hey, okay, let's talk about this, let's make a decision, let's be open to doing it. And so anyway, that's what I would like to see. And knowing that, that is active management, and not doing it for social good, but for a better investment for the fund, in that we could make a loan direct at the same rate that banks are charging and be a heck of a lot better than the yields that we're getting on our fixed income portfolio by the benefit of making those loans direct. I mean, you put your money in a bank, the bank gives you nothing and loans the money out at 5% and says, thanks suckers. Well, with a little bit of extra work, you can be the bank and make just as good a loans. So anyway, I'd like to see something in here saying that we would, this is my opinion, I don't know, everybody else, it's up to you, but to see the opening and availability of that flexibility.
Dan?
So I appreciate what Lee brought up, and I think you raised two different points. I'd like to address them separately. To go to your second point you just talked about, I'm interested in it. I appreciate you bringing it up, but I think that one of the issues that we've tried to address is the fact that, except for the courts, which is what an infinitesimal share of our investment and our members, like less than 5%, our revenues are largely derived, well, at least half of our revenues are derived from the economy here in Mendocino County. And so we're tied to that to a great extent. And so we want to diversify our investment portfolio. And the boards, I think a majority feel that way. However, you bring up a good point, and one thing I think that could potentially be created that would diversify it would be if we could work with other 1937 Act counties in other parts of California or other states even, or our equivalent in other states. Why couldn't we then have a big enough pool that we're not dependent on the Northern California economy, the Southern California economy, the Western region? It could be broad, and together we could share the risk and share the rewards. Because I think you're right. I think there would be better returns for at least a portion of our portfolio in a real estate mix that we talked about. I just think it needs to be beyond our county's borders and let other people have a little tiny share of their investment in Mendocino County. We're investing in Silicon Valley or et cetera. But the other point you raised, though, I think I disagree, which was in some asset classes, I agree with the statement, in some asset classes, active managers have demonstrated the ability to add value on average, while in other efficient asset classes, i.e., the recommendation you talked about earlier, which was
USA.
the large equities, where you feel like there's enough knowledge in the public and the world of investors on the value of those companies, you're just better off with an index. And so I think what this sentence is saying is the big stocks will just ride with the low fees index funds, but we do believe there's some added value in the small companies.
I was looking at the first sentence.
Yeah.
I agree with you 100%.
Yeah, okay.
And the second sentence in that is meant to say that there are still large cap equity managers that might add value, but you just have to believe that you can pick an above average one, right? And so that would be the case of your large cap equity manager, Jennison and Robeco. If you have them, you believe you're picking an above average manager because the data shows that the average manager doesn't do what you need them to do. Okay, so something in the philosophy about local investing, balancing the interest and ability to invest locally where opportunities arise. The only thing I grapple with, one of the things I grapple with is, Dan mentioned the correlation of, your ability to make contributions with your investments. And then the other is a governance structure. So currently excluding this building, all of your other assets are overseen by SEC registered investment advisor. So if you the board would be making direct investments, and then you fall outside of that governance structure where you've hired a fiduciary to do this for you. And I think that, that's the hurdle, that's what this group would have to figure out. How do we do this and have some sort of, something that fits the governance model that you're seeking?
Yeah, I do follow up on that with my thought on it, is how do you
make the decision when you're working with an organization like I think Lee was mentioning, where they're trying to get the best thing for their dollar that they can. They want to get the lowest interest rates, and we're over here giving them money where we need to get the highest interest rate. And what organization wins in that situation? We can't give them a better interest rate just because we think they're a good organization that deserves our help
Right.
and be fiduciaries for this system.
But you can do it at the same rate as a bank, and they would want to borrow from you rather than the bank, and, you know, everybody wins. Yeah, I mean, lending money can be a real easy, everybody wins. It's not I win, you win.
Right. So,
I think that ideas like this could have value if we're talking about being over 100% funded and we have discretionary, it's not really discretionary, it's still fiduciary obligation. But personally, I would see this as a challenge unless we knew we were going to be able to bring in more than 7% or a rate of return after all the various entities are paid.
Well, you need to look at it in terms of the fixed income portfolio, not the equities portfolio. Equities, we're looking at 6, 7, 8, 9%
Right.
in that bucket. But in the fixed income bucket, we're looking at like 2%. And so there's an area that we can get alpha. We can by active management, we can make a difference in that bucket. And that bucket's 30% of our portfolio. So there's a way we can better our position at the same time as maybe doing some good in the community, or just making a loan on an office building in Timbuktu. But if it's a solid, good loan, it's not that hard to make loans. Let me ask you a question. You mentioned about SEC
having a fiduciary
advisor.
oversee the
So
investments.
a broker walks in the door and says, here, you want to buy this office building right across the street that's leased to General Motors for the next 50 years, and you can buy it on a 5 cap rate.
Yeah.
And we go, gosh, that's a great investment.
Yeah.
Where's this SEC magic come in?
Well, you would be acting as the fiduciary in the selection of that specific property.
We, the board,
You, the board.
right?
There's no one else buying it for you or monitoring it or managing it for you.
Right.
There would be no third party who is a prudent expert in that asset category overseeing it.
Well, you would hire an appraiser, you get an appraiser and you
So
get a.
the board would hire an appraiser, the board would hire a lawyer to do all the legal stuff.
Right.
If you owned the property, the board would hire a property manager. And some associations do that. They have direct real estate programs, and they,
CalSTRS does.
and they have a staff here to manage it, right? And then here you have the board, and you have a unique skill set and knowledge. But if you weren't on the board, I don't know if we have anyone else who has that unique knowledge and skill set.
Well, you have the unique skill set as far as our investments
Yeah.
in equities and debt, but, again, I think if we can, as a prudent board of intelligent people, who
Yeah.
any broker could sit down there in front of them and say, here's why you ought to buy this office building, or why you ought to make a loan on this industrial building.
Yeah.
This board has the capability to make, it's not rocket science.
Right.
And if by so doing, you can add substantial value to the fund, then, it's step up. Step up and do the work.
Yeah.
My clients for years, universities and foundations, they made a heck of a lot more money because their boards stepped up and did the work.
Right.
James?
So the idea of local investing or us getting much more directly involved in investing, whether it's local or not. There are a number of concerns and issues with that. We don't have the staff currently. We're going to have to significantly increase staff if we want to do that.
Why? Who? Do what? To put the check in the bank account once a month? All my clients, they didn't have extra staff to manage their real estate lending portfolio.
So we're not gonna vet anything?
You have people there to vet it. You hire consultants, they hire appraisers. You know, when the package comes, it comes with all the stuff.
If the board wants to make those decisions and accept that risk, then we'll do whatever the board wants.
I'm just suggesting that we consider at this point, putting it in our overall philosophy here, overall philosophy, an openness to that. I mean, Sonoma County has an open space district because I got the idea of an open space district put into the general plan when I sat on that committee 5 years before we put it on the ballot. If it hadn't been done 5 years earlier, we wouldn't have been able to put it on the ballot. Nobody dreamed of an open space district 5 years before that. So if we put it in here, and something comes along down the road, at least we will have thought about it in the beginning.
Dan?
So my question is, what would it take for an organization to exist like an affiliation of 1937X, who they're all bigger than us, so they all have more staff than we have, to collectively pull something like this off? So I don't see this organization being big enough to vet the projects all by itself. I could see us having some bandwidth to participate with 4, 5, 6 other 1937X throughout the state to do this, if it was a high enough party for each of those 1937X to do it. But I mean, it's intriguing what Lee brings up. If we could raise our fixed income returns by a couple percentage point, and if our total cost in this venture to vet these programs was a 0.5 percentage point, we'd be netting 1.5. You know, and bringing up the rear, the fixed income helps the whole portfolio, even if it is 30% of our portfolio or roughly there.
Jim?
Jeff. So to the point Dan's raising, there have been discussions at the Sackers Attorneys Roundtable over the years about trying to blend or add systems together to create a bigger amount, and I think maybe it was for private equity but some other discussions. I know there's some legal issues around it, but I don't know if anybody's actually moved in that direction, but I know it's been discussed before.
They were going to
Try to
do
do a
a
little
JPA
digging.
many years ago.
I'm sorry?
They was going to try to put together a JPA at Sackers, but it just kind of went away.
I'll follow up a little bit just
So-
out of curiosity.
It doesn't feel like we have to decide that to put it in here though, do we, necessarily today, or for this? I mean, I think that's a thinking outside the box for sure, and a good discussion, but I mean, that's not anything that has to necessarily be in this document, is it? But I see what you're saying put it in now and then it's there if we need it, but it still seems like if you have a project, or if somebody has a project, the project's gonna come no matter what's in this.
Well, I think really what it gets down to is if everybody at the table nodded and said, you know, if an opportunity came up to finance or be an equity partner in a really valuable project, a real estate, either equity or lending project, or combination of the two, we'd consider it. Okay, that's it. That doesn't mean you gotta do it, you wanna do it, you just say, we'd be open to put our heads together to consider it. And we talked earlier about having, about 6 months ago, about having a discussion about what it would take to actually do something like this. You know, what is the reality of how would you make a loan? Somebody came in and said, we want to borrow $1 million on a $10 million office building. First deed of trust. I mean, does it get any safer than that? They're putting in $9 million of cash behind your loan. You buy a stock, you own 100% of it. It goes down 1%, you lost 1%. You own an office building, it goes down $9 million, and your loan is still safe. So, so if we wanted to do that, what would be the process to consider an investment? You know, I'd be happy to give you a seminar on that. But, so it all gets down to like, is this something we want or open to do? And if our heads go up and down, fine. If they don't, then leave it out.
So,
If I could just add one little thing. Back in the mid-'80s, I believe it was, the retirement system loaned the county money to build some buildings.
Social services, was it?
No, that was a
Or
bond.
juvenile hall maybe?
What is now, was HR, that little building that sits off by itself. It was superintendent of schools, I think, at the time. But there were provisions put into it that the least the county could pay is whatever our assumed rate of interest was. And when they wanted to pay off the loan early, we had to go through and get somebody to tell us to discount that back so that we made exactly our 8% at the time. But we haven't done anything like that probably in 30, 40 years.
There's a great old hotel up there.
I thought I was thinking Palace Hotel.
There we go.
yes.
No.
Like something like that.
Does the language in here now prevent us from considering those things, Lee? Or you're suggesting that
No,
some
I'm
other
just saying,
sentence
it's
needs
a
to be
proactive, I
added?
think this is a proactive document. It's not a we won't do, it's just, here's what we believe and here's what we're open to doing.
So you're thinking there's some language that could be added to make it open for us in the future?
Yeah.
I think what you're talking about to me needs to be in the policy, not in the beliefs. I think it's more specific to a policy issue. Because we've already, we stipulate in our policy what our investments in real estate will be and what they'll be in bond. I think that's where that would fit, not in this.
I think since we're going to update our policy statement, this might be a bad place to say, well, here's kind of what we think, and as Greg said, therefore, this is why our policy statement is the way it is.
The one thing to your point is it would definitely cost staff time. I mean, could you imagine, like even your example of $1 million project, you know, load of what, all that stuff, every project like that's gonna take vetting. So that would be time consuming for staff, for this board, if we had people coming at us right and left wanting us to invest in things. That would be time consuming. There's no way that would not be time consuming, I don't think. There's gonna be a certain amount of due diligence we're gonna have to do.
Our clients that make a $1 million, $2 million, $5 million loan, they don't spend any more than 3 days on it at the most.
Okay, times 10 projects
But
that
then-
somebody brings forward, then what do we got here? I'm not saying it's not something we need to think about, not outside the box, and probably something in the future. But to me, if any project came before this board, it would have to be a major project. I actually liked your project about college housing, because I think that's something that's huge, that's big, that, you know, that would take some time, but I think you'd have a lot of bang for your buck.
But if you loan $3 million, you make a $3 million loan, and you're getting 2% more than what we're getting now, that's $60,000 a year. You can spend a little staff time to make an extra $60,000 a year. I mean, it's not, you know, insignificant. You really get bang for your buck by thinking, by working.
Sure.
I wouldn't be ready to nod today. I would want James and Greg to at least bring something back next month so that I can think about it.
I just want to also add that this is to start the dialogue on a belief statement, and we don't have to finish it today. Bring it back. Is that a consensus on the board to bring it back? It's for directions for staff to bring it back, like next month? Yeah.
With some suggested revisions.
Yeah. Yes.
Just a general comment. This is new to me, this belief statement. It seems long, and a lot of what I read are facts. So, I mean, is it just asking if we believe the facts? Or, I mean, I'm just curious as to this, is this common?
So having philosophy statements, it's a bit of a trend.
No,
I-
I understand philosophy statements.
Okay.
This isn't philosophy to me. This
I
is,
see.
you know,
Or belief statement,
yeah, it's okay.
and belief statement, right?
Well, I mean, you talk about Mendocino County employees is a long-term investor with investments that need to balance the, I mean, that's a fact. I just don't see it.
Hopefully we believe in facts.
Yeah, that's what I'm saying. Is that what this is? Yeah.
Part of it is, you could argue against some of these statements.
Some of them I agree.
Um,
You could.
Mendocino County is a long-term investor. I believe that, but you have people looking at you annually and saying, did you make your expected return on assets?
Yeah.
Which, okay, they don't recognize you're a long-term investor. Right?
Okay.
They don't believe that, so if we put it out there, sometimes these things are communication tools.
Yes, that's
To the
what I see
outside
this
world,
more
too.
as a communication.
Yeah, I think that's fair,
Or support for trustees to understand.
yes.
It almost feels like an introduction to the other documents that
Yeah.
it's supposed to work if you can't influence. Here's kind of the bigger picture, and then please refer to the investment policy statement for additional detail.
So, other counterpoint items, I put in here, tactically managing asset allocation in a successful and consistent manner is very difficult. I believe that. That's my belief. I read another state plan philosophy that says the opposite. That says the staff should have discretion to tilt portfolios based on short-term views. And staff needs resources to do research to implement. Right? So there are actually some people who don't believe this. But everything in here I personally believe, just to be clear about that. But you could, there's some things that people actually could debate.
Well, even the one after that, the strong governance procedures, will lead to more successful and sustainable results. It's just,
Or our high risk will lead to higher returns over the long run.
That's right. That's right.
Do we still believe that?
And some people take some of these statements and take them additional steps, right? You mentioned governance leads to success, sustainability leads to success. Some associations or public funds push that further and say, we're going to be an activist in the way we deal with portfolio companies.
And we didn't say anything about GSE.
ESG? ESG, yeah, exactly. And that's where that leads to. But we stopped short of going that way in this statement. It's just knowing how this organization is operated historically.
There is a hint at that in the last paragraph on the back page, on the back of the second page. To the extent possible, the association should favor investment processes which support sustainable results, strong governance, and effectively regulated financial markets. It's not all the way at ESG, but it does.
Any other comments? Okay.
We did ESG then.
Okay.
Very good.
Okay, great. So it sounds like we have a little editing to do with number 5, and should I come up with samples I've seen other places about the local investing like Lee addressed? Do you want to just see samples of language?
yeah.
Yes.
So we'll just have some samples.
Including recognition of alpha that can be gained by, active involvement in decision-making. And also that those are limited opportunity investments. They're not, they're not traded on the stock market. If they were traded on the stock market, it's easy. But
Right.
they're special opportunities, and therefore you have to work together.
Right. Okay, so I'll put together some sample there. You're meeting on the 20th next, so I apologize. I'm gonna be in Texas then, so I won't be here.
sorry.
then.
I'm gonna be in Arizona.
All right, on the 20th?
Me too.
So,
Me in Scottsdale, Phoenix, Scottsdale. By Gilbert. Okay.
baseball games?
So I might make it down.
Oh, I got a fly meeting.
Okay, but we'll put the draft together and then we'll decide if you want to talk about it at the next meeting or the meeting subsequent to that.
One after.
Maybe look at my watch.
It's
10.
It's 3 minutes after 10.
Okay. So the other two agenda items are capital market overview. I could go through that pretty quickly. And then performance, that looks at fourth quarter. And then we have a month of January update, which we want to share with you because it
Good,
makes you feel.
Because it's
good.
really good.
Please.
Because it excels.
Get the quarter,
Yeah.
ancient history.
So how much time do you want us to dedicate to those two topics?
Well,
You want us to get through those two in the next half hour?
if possible, that would be great, yeah. Or do we need to do a bio break, or can we wait another half hour?
I can do a half hour.
I could use a break.
Okay, why don't we take a 10-minute break?
Okay. Okay, great.
So we'll be back at 10:15. Let's reconvene the
Yeah.
meeting at
And, buying.
10:16.
Did you hurt yourself?
Okay, I'd like to hear
All
the
right.
rest of your presentation.
Okay, great. And thank you so much for the conversation this morning. I think it's very effective and I appreciate it.
Thank you.
So we're going to move on to Callan's 2019 capital market expectations. And there's a little bit of background on it. Sometimes I drone on with you
The
for
meeting
30,
was a little
45
long.
minutes and just- So I'll just hit the highlights here and kind of get to the punchline. On pages 11, 12, 13, 14, we provide a backdrop of what are we even trying to achieve here in coming up with capital market expectations. And over the years, there's been a debate about Callan's numbers versus the actuary's numbers and coming up with expected returns. So let me level set with you here about what we're talking about. We come up with a 10-year forecast for expected returns for you to come up with what your asset allocation should be over a reasonable forecasting model for investment implementation. That's a different exercise from an actuary who's coming up with, okay, what's my 30-year discount rate going to be in determining the funded status of the organization and contributions. So two different exercises. What we're trying to do is take, okay, what do we know about the economy? What do we know about capital markets? And come up with, okay, what's the best reasonable intermediate to long-term outlook for return expectations for you to implement policy? If we anchored ourselves on 40, 50-year return expectations like an actuary, it's not useful information for us to determine asset allocation today. Okay? So we have a shorter time horizon than the actuary. Okay? Our expectations are for index funds, excluding those asset categories where you can't buy an index fund, so private real estate, venture capital, hedge funds, there's no index fund return out, there's no index fund out there, so those are the one exception. But when I talk to you about our domestic equity, international equity, fixed income return expectations, that's assuming you just buy an index fund, which leads to the return expectation. So on an annual basis, we come through and we look at the capital markets and performance in the recent past, and say, okay, what do we think is a reasonable return expectation going forward? And again, it's that 5 to 10 year time horizon that we're looking at. I'm not going to tell you what's going to happen next year, because I don't know. I don't know what's going to happen over the next 3 years. But you know what? Over the next 7 to 10 years, we've got it's a lot more certain what capital markets will provide over that time period than over a really short time period. Okay? So that's really the exercise that we're going through. If you flip to page 16 of our presentation here, there are a number of things that we were contemplating at the end of the year when we're coming up with our capital market expectations. And a number of things were weighing on the market, which, as you know, led to a significant drawdown in the fourth quarter. Trade wars, low oil prices, the perception that we're going to have a weaker GDP growth going forward, and the perception that we had hit peak earnings within the United States. That the U.S. companies aren't going to have an earnings growth going forward, which has implications on the price of stocks. There used to be a lot of talk about the inverted yield curve and what that meant when the world was predicting increases by the Federal Reserve, which could lead to an inverted yield curve. And what does that mean to an economy? Does it cause a recession? Is it indicative of a recession? Does it have no correlation to a recession at all? And that was a tremendous debate towards the end of the year. A few other factors we were looking at were concentration risk within the equity market. I talk about the S&P 500 all the time, but most of the returns we've earned over the past few years in the U.S. large cap stock market has been really been driven by just 10 companies. If you take out those 10 companies, the U.S. S&P 500 has been largely flat. And then, of course, growth concerns within China, growth concerns within Europe and Japan, all hanging on the market. So it sounds pretty dour, right? Sounds awful.
And then January comes along.
And then January came along, but also we actually increased our return expectations this year relative to where we were sitting coming in last year. So why is that? The number one reason is that yields came up meaningfully over the year. So fixed income returns now have a higher expected return going forward because we're sitting 75 basis points higher than we were last year. So our forward-looking return expectation for bonds came up. Equities had a meaningful sell-off, and our equity return expectations increased about 25 basis points. That's a pretty meaningful move for us to make those adjustments, and largely based on those two things. If we flip ahead to page 17, here we take a look at valuations. So is the stock market expensive or cheap? And this is a very crude way of looking at this, of looking at the PE ratio for the last 15 years. So very much one lens looking forward. And we ask the question, is the US stock market cheap or expensive? The blue line here is large cap stocks, S&P 500. The green line is developed international stocks, and the yellow line is emerging market stocks. A few big takeaways here. All the lines are lower today than they were a year ago. Right? So the amount you pay for a unit of earning is less today than it was a year ago. That means your forward-looking returns should be higher than they were a year ago. How do they look relative to average? Right now, the S&P 500 relative to the last 15 years in PE is looking about where it, on average, it has been for the past 15 years. So that indication says, hey, we're about normal. The green and yellow lines are below their long-term averages. So it seems like there might be a little more opportunity from a valuation perspective in international markets, both developed and emerging. But that drop in the blue line is pretty meaningful. It brought us down from a time where we looked like our valuations were reasonably high to now where it's looking back to normal. On page 18, we look at volatility of the market. So volatility is sometimes code word for saying the market went down, right? You don't talk about volatility when the market is skyrocketing up. Last year we had a lot of volatility. And up until the fourth quarter, it was actually generally positive going up. But it was higher than it had been in the past. Fourth quarter, we had a meaningful sell-off and volatility once again returned to normal. When we talked to you last year, we noted that 2017's volatility was historic low, anomaly. The number of days VIX was above a certain threshold was so low it had never been seen before. This year was returned to normal. This past year was a return to normal. And the amount the market went up and down last year, that's the way the market normally reacts. There's nothing weird about it last year. It's just that the year before that was odd, of not a lot going on. Why was there a low level of volatility for a while? If you look at page 19, the Federal Reserve had long time stable monetary policy that was very accommodative to the capital markets. It was the Federal Reserve's mission to stabilize the economy and the financial markets for a long time. A few years ago, starting in 2015, they started slowly removing accommodation. And recall, they have two ways they stimulate the market. The first is the Federal Reserve rate, and we hear that a lot. That's what it's really easy to keep an eye on. But they have this other thing, which is the size of their balance sheet, which is $4 trillion. And the pace of the decline of that balance sheet is something that the market looks at a lot as well. So how many treasuries does the Federal Reserve hold? If they don't hold that treasury, someone else in the market does, and the yields on those treasuries go up, right? And that has been impacting the market just as much as the federal changes in the federal funds rate. The Fed has been reducing the stimulus over the last few years, and in fourth quarter and last year, there was concern the Fed was going to overdo it. They were going to kill the growth of the economy through increasing interest rates. That was one of the concerns of the market. I have a chart in a little bit that shows it in greater detail. But you can kind of get it on this chart as well. So this line chart shows the Fed funds rate over time, shows the long time period that we sat for years at 0 to 25 basis points, the slow increase up to where we are today, 2.25 to 2.5. And then the dotted blue lines are year-end estimates of what the Federal Reserve says the Fed funds rate is going to be. This is the people who control the number saying this is where I think it's going to be. And then the brown numbers are where the market thinks it's going to be. Right? The market doesn't believe the Fed. Right? And for years this has been the case. The market is saying you're not going to increase rates as much. And then fourth quarter last year they were like, oh, they might actually do this. Right? What I find really interesting is that purple dot over to the right, the 2.75%. So what that number is if you ask the Federal Reserve board members, what do you think the normative Fed funds rate should be? What is that number? If it's not too hot, not too cold, I'm not stimulating the economy, I'm not restricting the economy, what is that rate? They say 2 3/4. 50 basis points higher than we are, 25 to 50, higher than we are today. So by that statement, they say, I'm still stimulating the economy today. I am a tailwind by their belief. So if they think inflation is going to run too high, they want to go above that rate, right? So why are they below it today? We're at 3.7% unemployment rate. Labor force participation rate's the highest we've seen in a decade. Wage growth is increasing. Why are they below this rate? And I think there are two things to consider there. The first is the Fed would really love to be north of 2 3/4 or at 2 3/4 so that if we hit a recession, they have the ability to stimulate the economy by cutting. Okay, so that's why they want to return to normal, so that I can stimulate the economy when we need it. The number one way to help a recession, though, is to make sure you don't go in recession, right? And I think that flip argument is what changed with the Fed and market expectations in the fourth quarter, and that the Federal Reserve, now people are going to believe, okay, they're not getting a race back to normal. They want to get to a point where they don't kill the expansion, because that's the best way to prevent needing to cut rates in the future. And I think that's a little bit of a change in mindset. Okay? On page 20, we show historic yields over time. For blue is the 10-year treasury, gray is the 2-year treasury, and yellow is the dividend yield in the S&P 500. A couple big takeaways here. Bonds are now yielding more than stocks, and that's different from where we were for the last decade. So that's going to drive investor preference for bonds over stocks more than it was before. And on top of that, bond yields have come up meaningfully over time. Two big takeaways from that chart. Page 21 is a complicated chart that says, okay, what's valuation like in the credit markets? After the sell-off in the credit markets in the fourth quarter, we're now looking at relative, our valuation now is back to average. Where before, credit was expensive. Corporate spreads were low. The amount of compensation you would take on for extra credit risk was low, and we're now back to normal. I just point to page 22 quickly because a lot of people actually like this chart. I wish I could tell you what 2019 the ordering is going to be here, but this shows asset classes over time, and it puts them in color-coded boxes. So graphically you can see with your eye that it's really, really rare for one box to repeatedly be in the top or the bottom. And you look at how it changes over time. We use this chart to not so much as data, but more as why you have diversification. Why do you have multiple asset classes? Because these things jump around all the time, and even though the US stock market has trounced the international equity market for several years, we can't assume that's always going to happen. And that's one of the big debates our investors are dealing with right now. Why do I have international stocks when the US stock market is crushed for the past decade? Well, it's not always the case. And you need to have multiple asset classes because the ordering of these boxes move around a lot. Page 23. This chart shows the correlation of stocks within the S&P 500 to each other. is Apple correlated to General Electric? Cross correlation within the stock market. When the blue line is high, it means they're all moving up and down in tandem. When it's low, there's differentiation within the stock market. When the number is low, active managers tend to add value. When the number is high, the market is just moving up and down together. There is no differentiation. So you see the spike here in the most recent time period, the market move up and down, there's no differentiation going on. So active managers actually had an awful 2018. And this is part of the explanation of what's going on. Being overweight energy also hurt, oil collapsing, and then overweight technology generally also hurt. Because Apple I think was down 30% in the fourth quarter. On page 24, we show the returns of broad markets over the last quarter, year, 5, 10, and 25 years. And let's just look at the 1-year column here. And how many numbers were positive?
1, 2.
Not many. So it was a brutal year to be an investor. Bonds sold off and stocks sold off. It's pretty much the perfect storm for the investor. The few areas where you had a positive return were T-bills, so cash, real estate, and then private equity. Arguably, private equity has a lag that you're not really seeing yet. Nevertheless, 18% return is awesome. I'll take that all day long. But pretty much every other asset class was negative in the year. So really hard year to be an investor. But let's look at the 10-year number. The only way you get a positive return over the long run is being able to stomach that 1-year return. That's what it is to be an investor. Okay, so let's look at the 10-year column, and this doesn't include the global financial crisis anymore, which is hard to believe. If you look back 10 years, it doesn't include that anymore, right? So the equity numbers look abnormally high because it's just the rebound from the global financial crisis onward now. You might want to ask, okay, Greg, if I was here 9 years ago, how far off were you with the 10-year forecast? We underpredicted the equity rebound, but we were still pretty bullish on equity, especially vis-a-vis our peers in the US equity market. Fixed income expectations are pretty much spot on. Cash is a bit of surprise. I would have said you'd make 2% in cash. You made 37 basis points for 10 years sitting in cash. That's truly astonishingly low. Real estate, spot on. Private equity, spot on. So where were we wrong and a lot of investors surprised was the relationship of international stocks to U.S. stocks. International stocks still had a 6, 8, 10% return, and we would have guessed about 7. So it's not so much that we were really far off by the number, but it's the relation of the U.S. to the international market, which is really a surprise. A lot of that has to do with currency. The other surprise that I think is noteworthy is commodities. So for 10 years, commodities have lost, on average, 3.7% per year. So, I mean, that's not something we would have predicted, that commodities would be 40% lower today than they were 10 years ago. And a lot of that has to do with the price of oil and the difference in the price of oil over the last 10 years. Okay, so let's flip ahead to page 29 here and 30. And talk about GDP growth. So our forecasts for GDP growth within the United States is about 2.5% going forward. International developed is about 0.5% to 1% less than that. emerging growth we're seeing is 5 or 6% growth. That 5 or 6% growth sounds great, but it's lower than what people had been predicting 8 years ago for GDP growth internationally. All of this has implications on what you expect to earn as an equity investor going forward, because an equity investor, you own growth in earnings, which is highly correlated with growth in the broad economy. Best estimates for GDP growth for last year is going to come in just shy of 3%. It's actually been a really good year for GDP growth. It's among the longest expansions we've ever seen. You see that in the bottom right-hand chart on page 30. That light blue line is our current expansion. Left to right is the duration of the expansion. But you'll notice how shallow it is. It's just that bar is a lot lower than others. Most other expansions got to the rebound in GDP growth in about half the amount of time that we've taken to get back to where we are today. Inflation is on page 31. We have core inflation as well as CPIU.
Great.
Yep.
Can I back up there?
Yeah.
So the current expansion has gone on for a lot longer, but like you said, it's been less steep.
Yeah.
Is there a relationship between the steepness of that expansion and how long it goes on, you think?
I think there could be, and that in the steepness of the expansion could lead to excessive growth or bubbles.
Right.
Where
Inflation and Fed tightening and everything else.
Exactly, which could lead to its demise more quickly. So it certainly could have an impact. Another thing going on is if you look at the ordering of this, our expansions have been getting longer over time. The market, our GDP growth used to be much more up and down. You know, you grow, recession, grow, recession. Now the growth is longer, the recessions are shorter, and it's the great normalization, or what they call it, when Clinton was president, what they call it, it's not the normalization, but there was this perception that, you know, the business cycle has ended. We're just kind of like steady state now. One problem with the length of recessions now, though, is that bubbles grow slowly and they can be hidden. And you don't notice them overnight. It's kind of like boiling a frog, right? The frog doesn't know it's being boiled until it's too late. And so that's kind of what happened with the global financial crisis, with the housing bubble, the lending bubble, and that this thing just grew over time. And you didn't realize there was the problem there until it revealed itself. Inflation on page 31. CPIU is the yellow line, is more volatile. It includes food and energy. Oil is really driving that a lot. The blue line is the more stable one. And you'll see we're north of the 2% threshold for the Fed, which means the Fed should be feeling like they can increase interest rates. The market currently thinks that they've got 2 more hikes in 2019. It wouldn't shock me if they do more, frankly, because there's no reason for them not to, unless we have the economy roll over.
So when you say hikes, are they 0.25% each time, or are they different than that?
Yeah, so the market is currently predicting 2 0.25% increases, and then there's some indication that some people are thinking that this time next year there's going to be a cut.
Wow.
Meaning that we're going to be heading toward a softening in the cycle during the year, and then a cut this time next year. Okay, in the interest of time, I'm going to flip ahead to page 40. And here are Callan's 10-year expectations. The big takeaway here is that, what I mentioned before, our equity expectations went up about 25 basis points. Bond expectations went up about 75 basis points. Whole lot of numbers here. You can ask me a question if you want. We'll flip ahead to page 42 and just show you what our expected return on assets is for your current target asset allocation. And this gets a little jargony, but based on our 10-year forecast, you have an arithmetic return of 7.5. Last year we said it was 7.2. So roughly 30 basis point increase. Your geometric return, so that's the number you would use for discounting things, is 6.8. Last year that was 6.4. Okay? So our 10-year forecast is coming up. Now you might say, okay, Greg, I know you've shared with me this normative return that's a little similar to the actuary in the past. So in the past, we've said that's 7.3. So now we're about 10 to 15 basis points higher than that today, sitting at about 7.4. And that's index funds for the public markets, and then real estate is not an index fund. So here's something to reflect upon. So we changed our 30-year forecast 10 or 15 basis points. Our 10-year forecast up 30 basis points over a 1-year time period. I think this is actually a good example of why you don't want to fidget with that EROA every time period. Because it's just 1 year past and we've got a different number, and it dramatically changes your policy, right? And it's just a case in point that you might want to look at long-term numbers that are more stable than something that goes up and down all the time because the bond market went up and down in a year. On page 43, so this shows for your target asset allocation what could happen in any time period. So I told you that your expected return is 6.8 on a geometric basis. What this chart shows is, well, what's the uncertainty about that forecast over any 1 year, 3 year, 5 year, 7, 10 year, and 30 year. So the uncertainty of the forecast is standard deviation. The more risk you have, there's less certainty in the forecast, and the higher standard deviation you have. And the likelihood that you have a negative return goes up with higher amounts of standard deviation. So over a 1 year time period, 90% of the time, we think that you'll have, even though I forecast that 6.5% return, I think you could have a return of 27% in any year or higher. 9 out of 10 years. No, wait, I said that wrong. 1 out of 10 years. Whoa. 1 out of 10 years. And I start with the good news. It's 27% or up. But I think it's perfectly normal for me, 1 out of 10 years, to come here and tell you, oh, you lost 10.5%. Or worse. So once a decade. To me, that's normal. So, yeah, you lost 15%. Right? I mean, to me, that's going to be a normal conversation. But I bring that up because that's what the equity volatility in the portfolio leads us to calculate. This would be normal, losing 10%. But you need to be able to lose that 10% in any 1 year to be able to harvest that 7% over the next 10 years. Okay. Any questions about return expectations or? Okay. All right. Now I've been talking way too long. I'm going to have Claire talk about performance.
And I think with the 30 minutes promised, we owe you 3 minutes. So I will hit the high points. Of course, if there are additional questions, please let us know.
I think Claire just said you talk too much, Greg.
Oh, I'll hear about it in the drive back.
No, it's all, we've obviously had very important conversations today, and I think the time was well spent on those topics. Looking back at fourth quarter performance is probably not where any of us want to spend a ton of time, but it is important to look at. So the first few pages are, again, just a recap of the capital markets as of the fourth quarter. Greg hit most of that. Big bullet points are that everything was down. There really wasn't anywhere to hide. Greg pointed to the The periodic table of returns, that colorful chart, that doesn't include cash. That was the one positive asset class in 2018. So certainly a negative year. Fourth quarter in particular was what pulled most of it down. But that being said, we did see a fair amount of volatility in the first quarter as well. We'd just kind of forgotten about it by September. So February, we saw a 10% drawdown, but the market recovered. This is the S&P 500. Much of that by the end of February. We then saw a negative return again in March, but then by September, everything was positive. So we've also included a January update, both for your portfolio and for the markets. On page 51, for the markets in particular, the S&P 500 was up 8% just in January alone. International stocks up about 7.5%, almost 8% as well. And then bonds were a positive 1%. So much of what was lost in the fourth quarter was recovered in January, but of course, as Greg noted, that kind of quarter in a negative year is not unexpected. I think your portfolio was down about 7% for the trailing year, for the 2018 calendar year, and that's within the bands of that negative 10% as normal. So looking at asset allocation first, I'll start on page 53. And this is a page that you look at every quarter, looking at the actual asset allocation of your portfolio compared to the target asset allocation that you set as policy. That's codified in your investment policy statement. And importantly, these two pie charts look just about the same. You are within your ranges, a couple points underweight international, a little bit overweight real estate. Of course, international was the most negative within the capital markets in 2018. But again, within ranges and within policy. So a good check. Page 54 looks at target actual allocation and target allocation over time. Not much changing here. There was, of course, one change, a couple changes in 2016 slightly, which reduced your fixed income allocation to 22%. You talk about this quarterly, you know that the majority of your risk lies in the fact that you have a high allocation to equity. That's both domestic equity and international equity. And that means that your fixed income allocation, so the flight to quality, which was what protected some of your return in the fourth quarter, is low. It's a long-term policy stance, but of course in the short term it does have a volatility effect. I'll skip 55, you do look at it quarterly, but it's just a reminder of what you look like versus peers, higher allocation to public equity, international and domestic, and you do not have allocations to what some of your peers have in private equity, real assets, other than real estate, international fixed income, etc. So what I think is interesting on this page is that percent of group invested, and there are lower percentages with the asset classes that you don't invest in. The majority of your peers all have domestic equity, international equity, and fixed income, and that's a larger part of their portfolio. Page 56 looks at the assets in the plan over the quarter. You started with $530 million. Investment returns accounted for negative $52 million. About $2.7 million left the plan to pay benefit payments. And you ended the year and the quarter at $476 million. There were two updates to investment managers that you use in the program that I'll just highlight while we're here. The first is Harbor International. We've talked about them for the last couple quarters for different reasons. So Harbor International is an investment manager that then selects a sub-advisor to pick the stocks and run the portfolio. What we talked about in the last two quarters is that they changed that underlying sub-advisor. It was Northern Cross, they selected Marathon, and that change was implemented last quarter. Last quarter and the quarter before, we told you that we know Marathon, we like Marathon. We were a bit unsure about Harbor's decision to kind of abruptly make that change, but we are confident in Marathon as a manager. This quarter, just about a week ago, Marathon, as the underlying sub-advisor, announced that they had let go one of the portfolio managers, a guy named Simon Todd. We don't have any cause for concern. We actually don't think this is a negative announcement for them as an organization. Simon Todd, it was decided that he did not fit with the personality of Marathon. He was a bit disruptive in the way that he managed and that he interacted within the organization, and so they let him go. As far as management, all of the coverage that he had was, he co-covered with a fellow named Michael Nixon, and so Michael Nixon will take over his coverage. And we don't expect any disruption for your strategy or for the organization, but we did want to bring it to your attention. So it's a bit odd because it is a new manager to you, but the manager that you hired was Harbor. So some change there. We will continue to watch it. We don't think it should be an issue going forward. In fact, it's probably a good thing if that was negative to the environment of the organization. The other update is to Barings, the core property fund. Barings announced that Scott Brown, who's the global head of real estate, will be retiring in June. You saw Chris Berry, who is the portfolio manager for you.
James and Stan did at our office.
Okay. No change to him. This is his boss's boss. So something that we'll definitely continue to watch, but doesn't have an immediate effect on the portfolio in which you invest. So 2 personnel changes. Again, we'll continue to watch both, but don't have any immediate concerns that they will affect your investments. If we move on to slide 57, this captures performance for the total fund. Last quarter, the total fund was down 9.76%. It underperformed the total fund benchmark, which was down 8.23%. So a very negative year. Again, the higher allocation to equity has a bigger tail on the short term. That is put in place as a longer term policy. And if we look at the longer term returns, they're actually quite strong, and that has worked out for you. For the last year, though, the plan was down almost 7% and did underperform that target. Greg noted that in the capital market review, the 10-year returns rolled off the global financial crisis, and that certainly had an effect on the returns for your program as well. So always a good reminder to remember that these returns are endpoint dependent, and we want to look at the bigger picture. That short-term return looks much worse than what we were looking at this table 1 year ago. The 10-year return looks better. So you rolled off 2008, rolled on another negative year, but a much less negative year.
Claire, just from my perspective, the number on this page that I always look at is that the last column, that total return, that's where I always focus because that's the longest term view we have.
Mm-hmm.
That's got both really good and really bad times. And here, obviously, with a very bad endpoint, it's below 7,
Mm-hmm.
which is the first time I've seen it below 7. But it's still 6.8% with a really bad endpoint.
Yeah.
That's encouraging for me. And that's always where I focus on this page, just sharing that with the board. That longest term view is the most important thing for me. So,
Fine.
So I have a question about that. So it says 14 and a half years. Is it just because that's the farthest you have data to go back?
That's exactly right. Yeah, there's no magic number of 14 and a half. We just keep rolling it out 1 quarter as we add another quarter on. It's the longest history we have.
So when we first started working with you about 9 years ago, we got data from a previous advisor who only could provide to us 5 or 6 years. So that's the history there.
And then the last point on this page, keeping the eye on that longer term perspective, that gray distribution represents other public fund sponsors that create a peer group. So that's the 10th to the 90th percentile of their performance over that time period with different asset allocation, different implementation. And your program is the green dot. The smaller number to the right in parentheses represents the peer group ranking in a number. So again, you've seen short-term volatility, but over the long term, you've done well both versus your policy target and in absolute terms. but also versus peers and their different asset allocations. We have fiscal year returns on 58 and 59. What's notable to me here is that you tend to be the top or the bottom. So you've had good years and you've had bad years. Fiscal year to date 2019 is in the bottom quartile. The 2 years previous to that were in the top quartile. You've seen bottom quartile returns before. Over the longer term, you have generated a strong outcome. We have cumulative results on page 60. Again, this is that 14.5-year time period because it is the longest we have. But the green line represents your program, and the red line represents the passive implementation of your target. So what if you just bought index funds? And the green line is consistently above that red line, meaning that your active management and your implementation has added value over time. It may not look like a lot right there. When translated into dollars on a cumulative basis, it makes a big difference. Slide 61, we always want to put this in perspective of the risk taken to achieve that return. The green dot is your plan. So on the left axis, looking at returns, you've achieved a higher return than the red dot, which is your total fund target, but with a higher standard deviation or risk amount of volatility taken to get there. Those numbers should be, so we look at the ellipse. The ellipse represents the peer group as well. We expect that to kind of skew up and to the right. So the more risk you take on, you should be rewarded for that over time, and that's been true. And I'll try to speed up a bit from here. The next 2 pages look at all of the individual managers in your plan, as well as asset classes. Last quarter, last year, very sharply negative returns, double-digit negative returns for the last quarter. Everything lost money over the quarter, with the exception of fixed income and real estate. Those are what you expect to be able to look to for diversification and to help buoy returns in a negative return environment, and that did happen. There are 2 managers in particular that I want to call out within your international equity composite. Greg noted that has been the most challenging asset category for this program. And within the top 4 managers there, those managers all buy big companies. And they make up about 80% of the total international equity asset class that you have for this program. 2 of those managers, Oakmark and Mondrian, are ones that we talk about frequently in this room. And that's because they have very different implementation styles and they will look very different from each other. Oakmark, Harris is the underlying sub-advisor there, tends to be a very volatile strategy and requires a lot of patience. So they're either at the top of the heap or the bottom. They are benchmark agnostic. They have run a very concentrated portfolio. They make big bets, and it has paid off over time. So their longer term returns, they're up 9.85% over the trailing 10-year period. That's annualized. But in the recent quarter, they were down 16.5%. In the 2018 year, they were down 23.5%. They require a lot of patience. That's consistent with their strategy, but that is a tough number to look at. As a reminder, Mondrian is part of the structure kind of for the opposite reason. I think we've looked at Mondrian's performance in the last number of years and they've lagged. And you as a committee have had patience with them because they're there to be defensive. In a negative market environment, they should lose less money. So they were down 10% in the last quarter, but they protected capital on the downside. So they are there to be a diversifier within the international equity asset class. And I wanted to point those 2 out because both of them have done what you put them there to do. We still have confidence in both managers, and we think that over the long term that they will do well for the international composite. In the interest of time, I can stop there. We have additional slides here that go through the performance of each asset class. So domestic equity continues to do well, particularly over the long term. International equity has been challenging. Fixed income has done very well. You have PIMCO and Dodge and Cox there. Those two managers manage very differently, but have both performed very well over time. And then the real estate composite, of course, has two managers plus the Kings Court property.
In our international, do you have any idea what our position is in the Shanghai market?
I can find that out for you.
Just if you know off the top.
Yeah, I don't know it off the top of my head, but I can find that out for you.
Given the decade-long underperformance of international versus domestic equities, what's your expectation for them going forward? Because now, are funds getting worn out with international and decreasing their holdings there? Or are people taking the contrarian view and moving more in that direction as they're looking at their asset allocation these days?
I think there's fatigue with international equity. I think a lot of people are frustrated with it or disappointed with it. And I would hope that people use it as an opportunity to rebalance, reinvest in the asset class, and also view it as a diversifier. So part of the dynamic that's going on is framing, right? Okay, international equity has produced a good return. In isolation, you'd be happy, but the problem is you're framing it, you're evaluating relative to U.S. stocks, which have just done so much better. If you believe in diversification, you're always going to have something do better than the other. Right? And so right now, international equity is on the losing side, domestic equity is on the winning side. I would hope that most people still view international equity as a diversifier. We need to keep it. But also, if you looked at the valuation characteristics we looked at before, it sure does look like a better valuation opportunity to me than the U.S. market.
Follow, if I may.
Sure. Are you on the forms and publications on the left-hand side?
Are clients better served, in your opinion, keeping the international domestic distinction, or moving more in the global perspective and just having a global equity portfolio?
Only global equity.
Oh, yes.
So they're
Not-
So there are a few different ways you could do global, and there are a couple arguments of why global. The first argument of why global is a beta argument that I should invest in international stocks equal to the amount of the opportunity set out there. And if you did that, you would actually own more international than you do in this portfolio. You're slightly underweight international stocks relative to the entire opportunity set. It's an academic argument that, well, if you don't have a view of the world, you should just own the opportunity set. Therefore, why not be 100% global? The other argument of why global is that global managers have this wider opportunity set and can add more value. There's more alpha in global managers. And there's two ways to access that manager alpha. Different argument, managers adding value. One way is to say, put everything in global and have those managers make more money because they have a wider opportunity set. The other way is to still have domestic equity, international equity, and then a component of the portfolio being global managers to go after that alpha. I kind of like that latter argument. If you want global for the alpha, then just carve out a portion of your equity portfolio. But you might still want to keep a bit of a home country bias in U.S. equity because of that currency volatility. So one could argue currency is an uncompensated risk, so why have it? So that way you control that uncompensated risk a little bit. A little jargony, apologize for that, but yeah.
Yes.
Are some of these, if by going global, then are you investing in what used to be American companies that have moved offshore? Does that make it easier, and, or have those companies that moved offshore, are they still traded on the, other than ETFs on the stock exchange?
If they move offshore and they're listed in another country, they very well may trade in that other country of domicile. You currently have exposure to those companies with your international equity managers. I'm trying to think of an example.
Like Anheuser-Busch or something?
Yeah, and Ambev. So that's an international company. You have exposure to that in your international equity portfolio. You already do. So when you say go global, what it says is, okay, I have this distinction of here are my US stocks and here are my international stocks. Why not just put them together and say, I want a stock manager, someone who invests across the globe. A number of those managers have done really well. Some haven't. One of the number one predictors of whether or not they've done well is, are you overweight US? Right? I mean, that's what's really driven a lot of the alpha, is that they've been long US and they've been long growth technology in the US. So I think a bit of that alpha might be fleeting. Now, having said that, you're giving someone the opportunity to add value for you in making cross-country decisions that you can't do in your portfolio right now. So I think there is a legitimate argument that you could have a few global equity managers do that for you while also keeping your US and international managers. What a lot of those global equity managers won't do is find opportunities in small cap US, because they kind of view the world a little bigger. They're not gonna go through the weeds and find this opportunity, that opportunity.
On the global equity, there are global equity indexes.
Yep.
And there are global equity active managers. What's the trade-off there in your mind? I mean, if you're just looking at the large cap, is the international space, has it reached the level of efficiency as US domestic markets? Or is it still inefficient enough where active management pays?
Large cap US is very efficient. You have to believe you're picking an above average manager. Developed large cap international is more efficient, but the average manager still has demonstrated an ability to add value. So if you pick the average manager, you'll still be better than an index. But that premium has shrunk today relative to 15 years ago. And in emerging markets, active management still pays. In international small cap, active management still pays. So the evidence bears that out. So I just told you that the average manager does well in international, but your fund has not. Right? So, okay, what's up with that, Greg? You remember in the past we had a couple manager, the Janus Overseas Fund. So a lot of the legacy historic performance was one manager who took large bets and was wrong. And we got rid of that manager. The PM was eventually fired on that strategy. But that Janus Overseas Fund is I would say the number one contributor to the asset class, your asset classification underperformance over time. So if I look at your track record, has all your active managers in aggregate done well or not? I'd say they've in aggregate have done well, but not every asset category you are in has done equally well. So your domestic has done well in aggregate, your fixed income, your real estate's done well in aggregate. International equity has been disappointing. If everything you're doing is working, that's when you actually need to worry, because it means they're correlated to each other. There's some correlation to each other. Don't mean that to be a cop-out, but if investing you're right 60% of the time, you're a winner. So I think that's why your portfolio has done well in aggregate, because you've been following that 60-70% rule, and it's worked out for you. Good. Okay.
Before we totally leave you, we did bring the January monthly update. So
Please.
Yeah. So for January alone, the total fund was up about 6%, ahead of benchmark. So active management did outperform in January as well. That brought the fiscal year-to-date return, which was negative, 7%-ish going into at the end of 2018. Fiscal year-to-date return is now negative 2%. And then we have longer term, last 3 years, up to about 9.4%.
Do you have the bottom line on size of the portfolio?
Yes, good question. So as of the end of January, the portfolio was over 500 million again.
Yay. Okay.
505 million. So saw an investment gain of $29 million over the course of the quarter, no money left.
Of course, it was like-
Course of the month, yes.
Yeah. Yeah.
Well, thank you so much for your time. I know we probably went a little over, but I think it was a good discussion, and we really appreciate you dedicating the time to hearing from us.
Thank you very much.
Okay,
Guys,
great.
Thank you.
Okay.
Thank you.
don't forget to look at the river as you go down.
No, it's flowing, and everything is so green up there. Yeah,
Oh my
it
gosh.
is nice.
How
We
it
were
used to
noticing
be.
moss on the
In many
rocks.
ways.
Isn't that crazy?
Yeah.
Yeah, yeah.
It always had so much rain.
You had to get that in.
Well, I had
during
my green shirt on.
James.
We had
Oh, it was
just
Jeff.
No, we just did, but we have had
The
it.
flowers are coming.
Oh my gosh. Yeah, my nephew lives in Reading. He lives in Reading, and he had 6 inches in Reading. Okay, what, we can take a 5-minute break. Have a safe trip back. All right, we're all back and reconvened. So next on our agenda is a quarterly budget update and
Thank you, Madam Chair. Trustees, you have the quarterly budget update before you. I will not belabor the point, but I'm happy to answer any questions you may have.
Yeah, who's gonna do this next time?
Yeah.
I'll talk about that during the administrative update. How's that?
Are we satisfied with the budget or any questions? Okay, well, then let's move on to the discussion and possible action regarding approval of cost of living adjustment.
I'd like to make a
Tim?
motion
Yeah?
after discussion, of course.
Okay.
Thank you, Madam Chair. Trustees, you have the letter from our actuary, along with their calculations and showing the COLA bank and how all this is projected and their calculation. Their recommendation is that the board approve a 3% COLA for retirees, and that will be effective April 1. And staff supports that recommendation.
Tim, why don't you make it, I'll second, and then we can discuss.
Okay, I move that we accept the actuary's recommendation and grant a 3% cost of living raise.
Second.
Okay, all in favor?
No, discussion.
Discussion.
Oh, okay, I'm sorry.
Discussion.
Have a discussion? Okay, all in favor?
Aye.
Abstain? Opposed? Okay. Is that what you want?
Thank you, board. As a member of one of the retirees, and representing everybody that's not here today, I want to show my appreciation.
Thanks
I'm
for coming.
down on it, I'm at the lower end of the fish scale, and it means a lot to me. So thank you so much.
Glad we're here.
Thank
coming.
you.
Hey,
We'll try to get you some better chairs.
It's all right, I like what I got. Better than the old metal ones.
So next I have a question for the board, what your preference would be to have the harassment prevention training next, or put that at the end of?
You want me to harass you now or later?
And how long does it take? How long
At
is that
the
gonna
end.
take?
2 hours.
Well,
hours?
it's supposed to go for 2 hours. If you want to go at the end, if you're bringing in lunch, I'm happy to do it while you guys are eating.
Oh,
Yeah.
wow.
And later, and is this mandatory?
Why do we
Maybe
have to
so
do
wise.
this?
Lunch will be here at
If
noon.
so
For
wise.
all boards?
So do you want me to answer that question?
Yeah, yes, please.
So this topic has been debated at SACRS conferences among the attorneys, whether you technically fit the legal definition of having it required. And I raised the comment, do you want to really have a board who doesn't have the training and then you have some issue? And nobody seemed to discuss it anymore after that. So I think there's a legal argument that perhaps you're not really supervisors and managers, but you are trustees of the system. I mean, some of you can satisfy it because you are employees. But so I can't say that with 100% certainty you're legally required to do it. Do I recommend that you do it? Yes.
And let's do it at the end.
Yeah.
Okay. Is there consensus, or do it at the end?
Yes.
All right, then,
Aren't we at the end almost?
well, next on the agenda is the administrative report.
Thank you, Madam Chair. Trustees, you have the administrative report before you, and just a few things to update you about. The election for the 7th seat, we did receive 2 applicants for that seat. And the election is underway. Friday at noon is the deadline for receiving ballots. Next Monday, the ballots will be counted and we'll have the results. And at that point, then at the March meeting, we will swear in a new member. As you know, Stan is leaving us, and we are currently recruiting to fill his spot. The job has been posted on the NeoGov website for Mendocino County HR. And we've been broadcasting that through Calipers and SACRS, and it was also published in the Ukiah Daily Journal. And spread the word if you know of anyone that might conceivably be interested. We encourage anyone and everyone that meets the qualifications to apply. Deadline for applications is March 4th, and we're going to move relatively quickly through the process.
Do you have applicants?
I do not know at this point. We don't receive the applications, they go to the Human Resources Office.
Where's the qualifications posted?
It's included on the job posting. So governmentjobs.com, careers, Mendocino CA is the website referenced here. Then just have to search for the retirement investment officer, retirement finance investment officer.
What's the length of the recruitment?
We had it out for 3 weeks, so March 4th is the deadline for submitting the paperwork to HR. So, is it midnight or 5 o'clock? I can't remember.
I don't know that they're necessarily time set.
Yeah, if they do it electronically, they may let it go past 5, yeah.
Yeah.
Would you extend it if you had a limited number of applicants?
I'm not going to make a hire just to make a hire. I'm going to make sure we get someone qualified and that fits with the organization and the management philosophy and leadership philosophy from the board and myself, and can fit well with the staff. So I will not make a hire just to make a hire. Although, until we get a replacement, once Stan is gone, I'm doing his job.
Oh, dear.
But we will see how that goes, and if that is not going well, we may have further discussions if we're not able to get a hire done quickly.
We know you're motivated.
So, We do. If we're not able to fill it through this search, we do have some options to potentially help us bridge until we can get someone in that we can talk about if we get there. So,
What's the general qualification in a nutshell in case we run into somebody?
4-year degree and some accounting experience, and I'm not sure how much accounting experience is required.
So it doesn't need
Kathy
pension,
Leader-Smith.
doesn't need pension experience, but
I'm reading.
accounting and a degree.
Yes. Yeah. I'm not sure.
Salary range?
I believe the listed salary range is 63 something to 77 something, but maybe I think there's a 5% premium on top of that. So it's 63 plus 5% to 77 plus 5%, I think, is how it works. So-
Confidential?
Yes, confidential. Confidential bargaining unit is what that means. And that's why there's the 5% premium. There's a 5% premium.
Okay.
So, any other questions there? If you haven't submitted your Form 700, the deadline is approaching. Please make sure you do so by the deadline. Next month, we'll start giving you legislative updates because the deadline to introduce bills is Friday. After Friday, we'll know what the list looks like. So that concludes my administrative report.
Thank you. Okay, so,
Just remember that the Form 700s are due to me here in this office, even if you do file elsewhere.
okay. Next, we would go into closed session.
Yes.
So,
The report out. Are we
Yes.
good to go?
The sugar
Yes.
in it? Yeah.
For Mr.
Just
Adams,
the fact that they're sort of crunchy.
amended application, the board unanimously denied his amended application for service-connected disability retirement. And on the other matter, no action taken, direction given to staff and council.
okay, and now we're into general member discussion. Any discussion? None, then we can move forward to our harassment training.
I'm so excited about this.
Well, as soon as you get some food,
Should we
Turn
adjourn?
this
Make
over
it
and
easier for folks,
this
so
side.
eat
Should we
Yes.
adjourn? It's not part of our
And
meeting.
do we adjourn?
No, it's part of the meeting.
It's part of the meeting.
Yep.
It's on the agenda, so.
So it's part of the
Lunch
So-
isn't quite here yet, so we've got.
Council has asked if we can put it on the screen, and we will do that.
My head's probably in the way.
Probably need, no, actually,
no,
you're,
because it projects down.
Oh, okay.
We're just
so we will,
But if you want to see it.
Well, I can also, I think
You can't even make.
So the
I
is
feel like-
the board education and training folder.
I'm not gonna
That's
sit
it.
through this.
Kind of cynical, huh?
When's lunch?
as soon as it gets here,
Okay.
they're usually a few minutes early. How dare they be?
Who is it?
How dare they be on top?
Is this the Mexican restaurant?
I believe we're having pizza.
Sure.
Oh.
My hands are sore.
And Saturday.
Critics, thank you.
Pizza. Wow.
So I don't know if food should be here any minute. Do we want to just break until food gets here and
Yeah.
everyone gets back?
Okay,
or-
let's do that.
Unless they're not already.
You need to take a
I might miss one. It's a slippery slope.
Okay,
qualify for the job in the first place.
I think we have.
I'll be right back.
No worries, you love him.
Oh, yeah.
So, thank you for indulging me for this presentation. These are the slides that I use when I do the training for supervisors and managers in Sonoma County. I've also done this training for attorneys and modified it slightly. I was just telling James, I recently did it for the county road crew. And that was a little bit of an intimidating group of 100 guys and 1 woman to do the training for.
Oh, interesting.
But I'll tell you, I think they came away from the training with a slightly different perspective. And anyway, obviously you've been reading about all kinds of issues in the newspaper over the last months and year or 2 years, and you had the Me Too movement and social media. And I'll kind of give you a little bit of history of the law on sexual harassment. I think it brings us to the current day and what the current civil rights issues of our generation are. And the Me Too movement has spawned in a lot of states, including California, some new legislation. So the training that the California legislature put in place in the mid-2000s, some people call it SB 1875, because that's the bill number that requires mandatory training every 2 years for supervisors and managers. And now starting January of 2019, that training is expanded to all employees. There were some other legislative changes that make it more difficult for employers to avoid having claims of discrimination go to juries. So what happens is if an employee sues their employer for some type of discrimination, the parties engage in what's called discovery, where they take depositions and interrogatories and change information. And then once that process of discovery is completed, employers in discrimination cases will then file what's called a motion for summary judgment. And that's basically saying, Judge, take a look at these facts, and as a matter of law, you should be throwing the case out now. It shouldn't get to a jury. And as you might imagine, employers don't want these cases to go to juries because they think they'll be more sympathetic to employees, their employees themselves. And so some of the legislative changes in 2019 spawned by the Me Too movement have made it so that it's going to be less likely for employers to be able to get out on a summary judgment. It's touched on so many issues, I mean, from sexual harassment to sexual assault, and politicians, movie stars. I mean, it was a big issue in the last Supreme Court nominee, Brett Kavanaugh. The Lieutenant Governor of Virginia is now facing issues related to these kinds of issues. Anyway, the first 10 questions, I'll just tell you the answers unless you want to shout them out. True, false. Number 1, harassment occurs when a supervisor repeatedly directs a subordinate to do his or her job.
False.
That's false. I mean, that's not the kind of harassment we're talking about. Number
Unless
2.
his or her refers to the supervisor.
Well, we're not talking about, true work-related kinds of activities. Number 2, employees can be personally liable for harassment. What do you think?
True.
That is true. It's not just supervisors or managers. It could be at a coworker level. Number 3, an employee should be disciplined for reporting harassment if the investigation shows that the agency's policy was not violated.
No.
That's false. We want to encourage people to come forward, and at the end of the day, there may or may not be a violation. Number 4, if the alleged
There's no
harasser had no...
responsibility.
What's that?
Encourage them to make allegations with no responsibility for false allegations.
Well, I will tell you my bias right off the top to address that issue head on, and that is I don't think people make this stuff up. I just don't think there's much to be gained from it. And I'm
Like
happy
the guy
to...
in Chicago?
Yeah, small that.
I can't say that it never happens, but it's such an awkward, uncomfortable position to have to put yourself in to make those allegations that's the basis for my bias. If the alleged harasser had no bad intent, it can't be harassment. False. If people laugh, the joke can't be harassment. False. Number 6, according to the most recent statistics by the DFEH, that's the Department of Fair Employment and Housing, they enforce the state's discrimination laws. I mean, employers want to encourage their employees to feel like they can maybe even tell the person to, maybe it's a low-level kind of thing, hey, it bothers me when you say that, and that would be great if everybody had that comfort level. Some people do and some people don't. But maybe there's somebody else in the organization that they can go to within their human resources department. But if they choose to do that, they can go to this state agency that enforces the laws. Anyway, according to their most recent statistics, sexual harassment claims are the most common. How do you guys know this? It's false. And the answer is retaliation. And we'll spend some time talking about that. And one of the key takeaways from this training that is primarily geared towards supervisors and managers is the importance of documentation. And you know, I don't even do that much HR stuff anymore, but I know how important it is to do evaluations and to be candid in them. And if somebody's got some issues with their performance, it's almost good for them to know what they are, of course, and give them an opportunity to fix it. But to have a paper trail in place is very important because retaliation claims can be defeated if you show there's been stuff going on before they engaged what's called protected activity. And we have some slides to go through that.
Question.
Yeah.
So these terms get kind of used interchangeably. People who supervise other people who manage other people. Within the county hierarchy, what's generally considered higher? Someone who's supervising other people or someone who's managing people?
So that's a good question, and there's actually a slide about it, and there was actually a published decision out of the county of Sonoma case about 10 or 12 years ago. It doesn't have to be the person that just prepares that person's evaluation, but if they're kind of their lead worker and they kind of assign them duties, then under the law, under these laws, they too can be considered a supervisor. So it's a little broader than you might think. It's not necessarily just the person who writes off on their evaluation. Number 7 is kind of like those other questions, 4 and 5. Jokes about an individual's own ethnic or religious group are not harassment. It's false. What do you think about number 8? Employees who report harassment can remain anonymous.
True.
False. Unless it goes to court.
Well, I think actually Sherry's kind of got it right, and so it kind of depends on the situation. If it's a fairly low-level situation, maybe it can be dealt with through some verbal counseling. But in the public sector, even a one-day suspension triggers a due process right to a full hearing. And so it's kind of this idea of fairness and being able to confront your accusers. And so if it is a more serious situation that results in any type of a pay loss, the person who suffered that pay loss absolutely has the legal right to know who their accusers were and what they said so they can defend themselves. Number 9, employees can be disciplined even if the investigation shows that the harassment was not severe or pervasive enough to violate the law.
That's so true.
That is true. And so, although the law is a little bit changing right now for the reasons that I mentioned at the start, it's actually a pretty high bar for a plaintiff to sue their employer to get money damages for sexual harassment. And we'll talk about the legal standard for an employee to get money damages versus kind of what's just appropriate conduct in the workplace. Number 10, a hostile work environment can exist when a supervisor has consensual relationships with subordinates.
True.
So, there could be certainly a situation where a supervisor and a subordinate are dating and the relationship goes sideways, and then the supervisor dings the person in their performance evaluation, or worse, what do you think the person's going to claim? Retaliation. I break up with you and then you do this to me. And that gets back to the idea of one of the key takeaways, which is on the next slide, I think, is the importance of documentation. So the things that we want to stress when we're doing this training is, I feel like, if you want to come over to the table, I feel like. So the key thing that I really try to impress upon supervisors and managers is if there's something going on, don't ignore it, address it, and try to figure out how you can alert whoever it is you need to talk to, whether it's your HR person or county council or whoever it is in your organization, so that the matter can be looked into, and you don't have to be an expert yourself. Yes?
My understanding is that if supervisors having, your supervisors having a consensual relationship with someone else, it is a form of harassment to all the other employees, not just because if they get into, they don't get along anymore, that because that gives that person an unfair advantage potentially in the work environment, whoever's having the consensual relationship.
Yeah, there's actually a case that went all the way up to the California Supreme Court on that issue in a jail, in a state prison, where the warden was having consensual sex with some of the female jail guards. And they weren't the ones who were complaining about any kind of harassment. It was their coworkers who weren't getting the better shifts and, you know, overtime and things like that. So that's a unique situation, but you're right, that does happen. So the key takeaways, one, identify the issues and contact the experts. Two, documentation, we'll come back to that again. And the third thing I call two sets of facts. The first set of facts are those that have already happened and there's no way the employer through its supervisors or managers knew or could have known about it. And the second set of facts are what you do in response once you find out. So the purpose of the training isn't to make anybody an expert, but to encourage them, of course, not to engage in the behavior themselves. And if the behavior occurs, to figure out who to talk to about it. And really, it's going to be the culture of the organization, right? If people feel like they can come forward and not be ostracized, or you know, that they'll never get promoted if they make some kind of complaint about something. So culture is really very critical. So a little bit of history. So back in the until the 1960s, employers, public or private, could hire or fire anybody for any reason or no reason at all. And so things that I think most of us take for granted today, even maybe free market economists. So in the 1960s, Title VII is the Civil Rights Act, and the state under the Fair Employment and Housing Act, that's what FEHA is. In the 1960s, there was a big debate, Civil Rights Act, and for the first time, employers could not discriminate on the basis of 3 categories, and these are called protected classifications. And you'll see I have a slide coming up, and the list in California has grown to like 15 items, but in the 1960s, it was 3 things. It was race, age, and sex. And both under federal law and then state law, it was saying for the first time, employers, public or private, you can't decide to not hire someone or you can't fire someone on those 3 grounds, race, age, and sex. And back then, there was a big opposition to that. I'm a private employer. You're telling me I have to hire a fill in the blank, a black person, an old person, a woman. And so now, this list, as I mentioned, is quite long, and the civil rights issue of our generation is gay rights. And so just a few years ago, the U.S. Supreme Court said gays can marry. But under half the states, and it's questionable under federal law, whether sexual orientation is a protected classification, or whether you could fire someone for being gay, or not hire them for being gay. And if you followed the case that I think was just last year, there's somebody in Colorado who designs and bakes cakes.
Mm-hmm.
And he asserted his First Amendment right of freedom of religion to not have to bake a cake for a gay couple. And to me, that sounds a lot like an employer in the 1960s saying, if I'm a private employer, are you telling me I have to hire someone who's, and the Supreme Court kind of punted on that case a little bit and really didn't address the issue head on, but I'm sure it's going to come back before then at some point. And the sexual harassment training now in California requires a specific discussion about gender identity and gender expression, and I'll get to those terms in a little bit. These are the slides that I use for Sonoma County, and that's those last two bullet points. I know Mendocino County has a policy, and you can imagine that almost all the policies say the same thing about inappropriate behavior. CSR is a reference there to the Sonoma County Civil Service Rule 10, the grounds on which an employee can be disciplined, and Mendocino County has similar rules. You'd never find an employee, by the way, if an investigation was done and they engaged in some type of inappropriate conduct, you wouldn't want to call it sexual harassment, because that's a legal term and it suggests money damages. What you would find is inappropriate conduct of a sexual nature, and that is a significant distinction. So who's protected by these laws? Both applicants and employees. That's pretty much what you'd expect. Who they're protected from is probably broader than you might think. So it's not just employers having an obligation to protect their employees from their coworkers, but also folks that you contract with or clients. Our retirees, the people that we contract with, the county of Mendocino, it's all the people you provide services to, health and human services, inmates in the jail. And so the employer has an obligation to keep their employees protected from those folks. So discrimination is conduct taken because someone is in a protected classification that the legislature has carved out, and I'll get to that list in a minute. We don't see this very often, but it's also protects folks if you perceive them to be in a protected class, even if they're not. So here's the list in California, and it starts out with the ones that, from the 1960s. So it's race, national origin, religion, sex, sexual orientation, gender identity, gender expression, marital status, age, medical condition, genetic information, physical or mental disability, and pregnancy. So if it's not on this list, not protected. Genetic information was a fairly new ad by the legislature, and it relates to physical or mental disability, and the idea behind it is if employers knew that an applicant for a job had a particular horrible family history of some disease, that they would be less likely to want to hire them. And so employers can't have any medical information. And if any of you have dealt with workers' comp claims or folks who have disabilities and they go through the reasonable accommodation process, all employers are entitled to know are what their work restrictions are. Every job has something called an essential functions worksheet that details all the physical demands and the psychological stressors of the job, or at least they should. And that's the document that would go to a doctor, and the doctor would look at it and say what limitations they have. Gender identity and gender expression, as I mentioned before, are also new ads. And these are the definitions out of the state regulations. And so you may or may not be familiar with these terms. So I'll read the definitions to you, and then I'll talk to you a little bit about it. And there's also been laws in other areas that deal with like birth certificates and driver's licenses, and it really is a huge issue. A person's gender-related appearance or behavior, or the perception of such appearance or behavior, whether or not stereotypically associated with a person's sex assigned at birth. Gender identity. Each person's internal understanding of their gender or their perception of the person's gender identity, which may include male, female, a combination of male and female, neither male nor female, a gender different from the person's sex assigned at birth, or transgender. And I will share with you that I have 3 daughters that range in age from 17 to 24, and they all went to school with somebody. They weren't necessarily friends with them, but they knew somebody who actually went through a transitioning from one gender to another. I don't do much social media. Does anybody know how many gender choices you have on Facebook? Anybody want to guess?
50-some.
That's right.
Oh my
I did
God.
that the other day.
My.
Yeah, 56.
Is that just in
Really?
California, or is that
Facebook.
Facebook's everywhere?
World,
That's true.
worldwide. So
Because I
I
look at
have
this
since,
and I think this is
Well,
California.
Right.
and it's not it's everywhere, and I don't know what shows you watch, but it's just kind of part of the mainstream. And I don't remember the statistics, and it's a small percentage of US population.
0.3%.
Yeah, it's a small percentage, but I think that might be right. But it's still like 2 million people identify themselves as gender fluid.
I have a good friend who had a daughter who had both male and female sex organs.
Born that way.
Born that way.
Yeah.
Transgender, a general term that refers to a person whose identity differs from the person's sex assigned at birth. A transgender person may or may not have a gender expression that is different from social expectations.
Can you explain that? The gender,
So I think maybe this definition helps explain it a little better, and I think I have one more slide after it. That's a good one. Let me just finish the last definition, then I'll go to that slide that's going to be too small for me to read. Transitioning is the actual physical process that some transgender people go through to begin living as the gender with which they identify, rather than the sex assigned to them at birth. This process may include, but is not limited to, changes in name and pronoun usage, facility usage, etc. So this was a slide that my daughter, who does implicit bias and other kinds of training, gave to me. So gender identity, I have to get even closer. No, I'm too close. So gender identity, how you in your head define your gender. And gender expression is, can anybody else read that? Maybe on your slides.
Feminine and masculine, is that what you're, under gender
It's
expression?
underneath it.
Oh, underneath it.
Do any of
Oh.
us not know what you're saying? You need to go through.
Well,
Well, I-
I heard that there were some questions.
The gender identity versus gender expression, I've not heard of the distinction there before. I mean, I've not heard the term gender expression. I know what.
So expression is how you express yourself, and maybe how you dress and how you talk, and identity is how you think of it in your
But you
head.
might think of yourself as one thing, but not dress and talk that way.
True.
I might be able to see my on the slide.
That's okay. So, is there something you'd like to share with the group?
I wouldn't dare.
We are being recorded. Are we televised on this one?
Yes, it's being recorded because it's part of our meeting.
Okay.
2017, some additional regulations. Employers are prohibited from seeking gender or sex-related information from applicants and employees, and must honor employees' request to be identified by a particular preferred gender name or pronoun. And another issue that has caused some consternation in the jails, which more difficult to deal with these issues than some of the other places where you can have a gender-neutral bathroom. But that's been an issue that's been difficult for sheriff's offices. The Gender Recognition Act just took effect last year. Procedures related to the issuance of birth certificates, driver's license, and other court-issued documents now must include a category designation of non-binary, where you're not identifying someone as male or female.
I've not heard that one.
And now that it's a protected classification, it can create liability for employers. So retaliation. I mentioned that this is the #1 area that the state is seeing complaints in, and I'd like to talk about it in the context of a case that was a pretty celebrated case down in Silicon Valley a couple of years ago, where a lady by the name of Ellen Powell worked for Kleiner Perkins, which is a venture capital firm. Lot of money at stake, private equity, you guys are familiar with that topic. Very male-dominated work environment. Ellen Powell worked for Kleiner Perkins for like 15 years. Very impressive credentials, Ivy League, undergrad, grad school, law school. She was trying to be a partner. She files a lawsuit against Kleiner Perkins claiming sex discrimination. not sexual harassment, but that she's treated differently because she's a woman. And there's a 2-3 month long jury trial, and the jury, sorry, I left one piece out. So she files her lawsuit claiming sex discrimination, and she's still employed, and after she files her lawsuit, she's fired.
Oh my God.
What do you think she adds to her claim?
Oh, yeah.
Retaliation. After a 2 or 3 month jury trial, the jury comes back and finds in favor of Kleiner Perkins. So what do you think they must have found? That there was a good reason for her to be fired.
Yeah.
And I don't even know the specific facts, but I'm quite confident that they were able to show that the performance issues that they were having with her predated the filing of her lawsuit. And so that's why I say it's so important to document. And it doesn't mean that, because that's the protected activity, that's the first part of this test, was the employee engaged in a protected activity. Filing a lawsuit claiming sex discrimination is protected activity. We'll talk about what else that means, but if you can show that there was stuff before the protected activity, you're going to be in a much better situation to defend yourselves than if it comes after. So the first part of the test is, was there protected activity? That term's in quotes. We'll talk about what that means. The second part of the test is, did the employer take any adverse action against the employee? In the Ellen Powell case, she was fired. That's the most adverse action. So she had satisfied 1 and 2, but not the third part of the test, which is there a connection between the two? Was the adverse action taken because of the protected activity? And the jury said no. So what is protected activity? It's being a complainant of complaining of some type of discrimination or harassment, a witness to that. You could be a whistleblower saying your employer is doing something illegal. Free speech, maybe you go to a board of supervisors meeting and during budget negotiations and say you should be getting more money, and then some discipline flows your way after that. The Janowitz case is kind of interesting. It's in there because it's kind of got a unique fact pattern. That was a California Supreme Court case maybe 7-8 years ago. Janowitz was a very high-level manager for L'Oreal, which is like a clothing, fragrance, cosmetics kind of firm. Anyway, she's there for a bunch of years, nothing in her personnel file, and the big boss comes in and says to her, I want you to fire the receptionist because she's not hot enough. And she thinks, how many of you, by the way, think if she would have fired the receptionist for not being hot enough, that that's discrimination?
Yes.
Anybody think it's not?
If you go down your list of what's protected, it's.
Yeah, being hot was not one of the protected classifications.
That'll be next.
There's something called a bona fide occupational qualification. If the employer can show there's a business reason why somebody maybe needs to look a certain way, the image of the company, then that may be okay. But she reasonably believed, like I think most of you did, that if she would have fired this person, it would have been illegal. Anyway, she thought it was wrong and she just ignores it. He comes back and says, I thought I told you to fire her. She still doesn't do it. He transfers her to some less desirable location somewhere else. She goes out on a stress leave and files a lawsuit. And so at the lowest court level, the court threw it out on summary judgment and said, you didn't engage in protected activity because you didn't do anything. You didn't tell anybody. And it goes up to the California Supreme Court, and they said, under these unique facts, we think that you did engage in protected activity, just simply not doing anything because she was a high enough level manager. Anyway, it just shows that the courts are still trying to figure out what protected activity is. But in most cases, it's pretty obvious. If you're filing a lawsuit or you're reporting some kind of discrimination, that's a form of protected activity. Yes?
The word hot has sexual connotations in that respect. It's not just a word that means the temperature in the room.
Right.
So,
No more than L'Oreal. I mean, they're in the hot business.
not necessarily. No. I
Not
mean, just because this person wants to look a certain way, there's a distinction between, let's say, trying to look businesslike or trying to look hot.
Depends on what business you're in.
Right, of course, but, it's just a really
it's an interesting case, but, you know, I would wonder about that as far as it not having some kind of a protected class status.
Yeah, well, then that goes to this idea of the business, a bona fide occupational qualification. What's the image that the company is trying to
Right.
portray? And,
Yeah.
I mean, that wasn't the issue in the case, but
Why'd they hire her in the first place then?
Right.
well, I don't know, but
She was
obviously-
hot and then got unhot, or? Yeah.
Well,
Senior
She cooled down.
that would have been one of the arguments, right?
Yeah, it
You see
sounds
the airline
discriminatory to me.
They are the hottest looking 70-year-olds in the sky.
Yay.
So second part of the test, adverse employment action, it's very broadly defined by the courts. It could be a ding in a performance evaluation. It doesn't even have to result in a pay loss. And then again, the last part of the three-part test is there a connection between the two? And again, the importance of documentation.
So you'll take question?
Yeah,
A situation.
it's always a friend.
Yes, no, this was me. This was me. Had chaired a board in Sacramento. Someone who worked for that board just did an inferior job the whole time. As chair, the board told the CEO to fire this person. Being Sacramento, instead of firing him, he was moved somewhere else. I didn't know where at the time. Several years later, I came back to Sacramento as an employee and was put in charge of a division. And guess who's there? So the person who was in my job before had almost 2 years of documentation on this very poor employee. Showed me the file. I knew I was going to have to continue to document, but it was close to time to say goodbye to this gentleman. I left, came back on Monday, and the whole file was gone.
Wow. Oh my God.
So what can you do in a situation? My choice was either go after him again or let it go. And I let it go. I thought it was the only thing that I could legally do because I had nothing that could document. Otherwise, I would be seen as I came to get him and get rid of him.
Well, I mean, that's an unusual fact pattern, but I mean, I think the fact that the file's gone, and you said you had talked with the employee about their issues?
No, my
'cause you
very
inherited
first
it?
day coming in as their supervisor, and I look in the file, which I had been shown the week before, and the whole file had disappeared.
Well, I think the fact that you're a new I mean, I don't want to sidetrack this too much, but I
No.
think you could rely on the other folks who knew what was in the file, because why would they make it up? It's not even their person anymore. So there might have been another way to go after that.
They do.
Anyway.
No, the fellow who had the job before me had spent 2 years documenting everything.
So whether it's Sonoma or Mendocino County, you know, there's policies and procedures, and there's, the policy defines what's prohibited, and the procedure talks about what the process will be when there's a complaint. And it's really kind of been interesting to me, and I won't get into the specifics of the Brett Kavanaugh hearing, but in the employment context, it's a very kind of a standardized process on what to do, and that really doesn't even exist in universities, which I've just found out. And I don't want to get political, and I don't want to go down that road, but it's a huge issue right now in terms of sexual assault and sexual harassment on college campuses, in terms of what the burden of proof is and how those, how due process is satisfied. But in the employment arena, it's very clear. You know, there's going to be if it's a serious situation, there's going to be an investigation, and you'll talk to the person who made the complaint first. You'll get as much information from them as you can. You'll talk to whatever witnesses they have, and then you'll talk to the accused and whatever witnesses they have. And then it's up to that investigator at the end to decide whether they think it's more likely than not that the conduct occurred. That's the test, more likely than not. preponderance of the evidence, 50.1%. I went to a training many years ago. It was kind of a train the trainer, and this stuck with me. And it is, I mean, these cases are almost always going to be he said, she said, or she said, or whatever pronouns you want to use, non-binary. And so if you can't decide what's more likely than not because it's going to be that situation, then you probably shouldn't be an investigator. And there's going to be something that will tip the balance, and you learn to become an expert in demeanor. Maybe somebody told somebody contemporaneously, but there should be something that will help you tip the scales. Two sets of facts. I mentioned that's one of the key takeaways. And the initial set of facts are those that have already occurred, and there's nothing the employer through its employees could have known about. But it's really critical once you're on notice of something that you don't ignore the issue and you don't step in it. And by that I mean make sure you figure out who the right people are to contact. Make sure there's no more contact between the person who's made the complaint and the person they're complaining against. And these investigations can take a long time. Sonoma County's policy says they'll be done in 30 days. Sometimes it takes longer for a variety of reasons. The person's represented in scheduling interviews, and depending on the number of employees that have to be interviewed. So you're going to have to figure out what happens with those parties while the investigation is ongoing. And so what do you think would happen if a department head or whoever is the head of the organization says, I think it'll work best while we investigate if I move the person who made the complaint over here? What do you think they're going to claim?
Retaliation.
Retaliation. I make a complaint, you're moving me? So you want to provide options to the complainant. Hopefully there's some that work for the employer and for that person, and let them pick it. And then you have a paper trail that kind of sets it up that says, you know, you made these allegations, we take them seriously, we're going to investigate, here's what's going to happen while the investigation's pending, and you're off to a good start with your second set of facts.
Jeff, what about their legal representation? Does the employer, the agency have any obligation to provide an attorney, or on either side?
So no obligation to provide an attorney. In the public sector, if they're a union rep, if they're a union employee, they'll be represented. If they're management, it'll be up to them to get an attorney, and they're absolutely entitled to one. And so I mentioned the letter that's going to go to the complainant. The alleged perpetrator, the person who's being accused, is also going to get a letter, and it's going to advise them of all of their rights. If a person who makes a complaint wants to bring in an attorney to their interview, we wouldn't refuse that.
And they could be in the
But
same
there's no
union.
obligation.
Yeah.
They could actually be in the same union, too.
That's, absolutely.
Yeah.
A question about that too, is like if someone is department head or elected official, is there any possibility that county council they could help? No, they're just completely on their own.
County council is the attorney for the entity,
Yeah.
not for any individual.
So when this happens, would there be cases where the complainant would be filing something against the county rather than, you know, if it's a department head or something, they could, or let's say they've never taken a sexual harassment training, or they should have, or something, and the county hasn't made sure that they have, then this person, they could conceivably file a lawsuit against the county.
So two separate issues, right? If there's a complaint, I mean, let's say they never even came to the county and they just filed some complaint with the Department of Fair Employment and Housing.
Yeah.
I think most employers, I know the county of Sonoma would do its own internal investigation on that complaint. And so, you know, you can't control what the complainant is going to do, whether they file a lawsuit or not, but you can certainly do your own investigation and take the action that you think is appropriate.
It seems like they would almost sue the county in that, if it was a department head, they'd go after the county instead of the individual anyway.
Deep pockets?
Deep
It
pockets,
depends.
yeah.
I mean, I've seen
Yeah.
it go both ways.
Yeah.
So types of harassment, quid pro quo, and hostile work environment. Quid pro quo is a Latin phrase. It means this for that. So job benefits promised in exchange for sexual favors or denied if sexual favors are not given. And I have to say, I used to kind of quickly pass over this because I thought, you know, whether it's the county of Sonoma or the county of Mendocino, the hiring process is so bureaucratic and formal, how could this ever happen? But I think that's probably naive to think that that's never happened, whether somebody's been in an extra help position or who knows what. So I really do encourage people, if they're aware of anything, I really encourage them to come forward. One thing that just made me think about was that when I was giving kind of the history lesson of the 1960s, I left out an important piece. So remember, it was race, age, and sex.
Mhm.
There's nothing in the law about sexual harassment, or there wasn't at the time. And then you fast forward from the 60s to the 1980s, and there was a lady who worked at a bank, and she claimed that her coworkers in the bank were making comments of a sexual nature. And she filed a lawsuit claiming discrimination on the basis of sex. And in the 1980s, this case went up to the U.S. Supreme Court. And the U.S. Supreme Court then said, for the first time, this is sexual harassment. It's a hostile work environment, sexual harassment. If conduct is severe and pervasive enough, then it can be considered discrimination on the basis of sex. So following that, in the 1990s, there was a lot of lawsuits about sexual harassment, and then it kind of got quiet until just a couple of years ago. So that was the part that I left out that I wanted to just share. So hostile work environment, this is the legal test. Going back to that case from the 1980s. So it's physical, verbal, or visual behavior of a sexual nature. It has to be objectively and subjectively offensive. And what that means is, objectively means a reasonable person would find it offensive, and subjectively means that particular person themselves found it offensive. And then the last part of the test is it has to be severe or pervasive. And I'll talk about it in the context of sexual harassment, but it could be harassment on any one of those protected classifications, right? So it could be race, so it could be physical, verbal, or visual behavior of a racial nature, or somebody who's pregnant, or whatever is on the list. So what is severe and pervasive? It's determined by the frequency of the conduct and the severity. And when I talked in the beginning about how the California legislature has made it so that more of these cases are going to get to a jury now, the short answer is they kind of lessened how severe or pervasive it has to be. And there's a case I have there, the Mokler case. And I think that, I'll tell you what happened in that case, and I'm pretty confident that you'd get a different decision today, even before the legislative change. This was about 10 years ago. Mokler was not a department head for Orange County, but one step below a department head. And the bad guy, if you will, in Orange County was on the Board of Supervisors. And so there were about 3 incidents over a 1-month period, and I didn't bring the case with me, but I kind of remember them. The first 2 incidents were kind of just more, there was no touching, but there were inappropriate comments, and he was kind of hitting on her, and he would look her up and down in a suggestive way and talked about how she looked, and just made some inappropriate comments. But the third incident was more serious, when he intentionally took his hand and ran it down the front of her dress and intentionally touched her breast. And so she files a lawsuit against him and the county, and it goes to a jury trial. The jury hears the evidence that I just told you and found that it was sexual harassment based on that touching and the other comments. And the attorneys for Orange County argued to the court that, and it's called a motion notwithstanding the verdict, and they're saying, Judge, you heard all the evidence, but here's what the law is, and even if you take all that evidence, that's still not sexual harassment. And the court agreed. So that was about 10 years ago. And what attorneys do who practice in any area of law is they do something that's called shepherdizing a case to see what other courts have cited to that. And since this decision, no other court has cited to this case. And I'm reminded of the situation, and I'm kind of forgetting exactly what happened, where a judge in a criminal case a couple of years ago gave a very light sentence to somebody who had sexually assaulted and raped a woman who was unconscious behind a dumpster.
Was that Stanford? A Stanford?
Stanford.
Yeah, swimmer.
And so you saw the reaction, and he got recalled.
Mhm.
I mean, I just, for so many reasons, I think you'd probably get a different result in a case like this. But at least up until this new legislative change, it really has been a pretty high bar, even in California, for someone to be able to get money damages from their employer for sexual harassment. And the Mokler case, you know, at least I think is still considered good law, but I don't think you get that same result today.
I'm just thinking of Mad Men.
Show?
Yeah. Talk about sexual harassment.
So, the disciplinary test, inappropriate conduct of a sexual nature may be welcome, people think it's funny, it need not be severe or pervasive, right? It just goes to the level of discipline, if any. Maybe it's just some verbal counseling. Visual harassment, posters, cartoons. Oh, you know what? I want to go back for a quick second. I don't think it really happens much in our context, but when I do this training for supervisors and managers, when I see the physically threatening or humiliating, I talk about the fact that the county, at least Sonoma, and I'm assuming Mendocino, has a threat assessment team.
Yeah.
So I want to make people aware of this, and it may have nothing to do with sexual harassment at all. I mean, you know, it could be county employees out in the field who are getting harassed by members of the public, and so in Sonoma County, you know, it's risk management heads it up, and you know, we're lucky that we're the county of Sonoma, we're county of Mendocino, because you've got the DA's office and the sheriff's office and mental health experts who can be on the team. Of course, the downside is people who hate government. But it's very serious, and I encourage people, if they think there's some issue, not to hesitate to bring it to our risk manager's attention, and if necessary, we convene the team and we meet. And, you know, there's legal things you can do in terms of getting a restraining order, and there's all kinds of things that we've done, security systems for more serious cases, getting a temporary security guard and different things. Visual harassment, posters, cartoons, bulletins, calendars, staring, leering, emails on the internet are what I want to spend a minute on. So obviously we've seen all kinds of situations where folks have accessed things and forwarded things that they shouldn't be doing in the workplace. And in Sonoma County, our policy is very clear that lets people know that they have no expectation of privacy in the county's computers, because when the government does a search, it triggers Fourth Amendment protections of search and seizure, whether it's an employment relationship or not. So we make it very clear in the policy that there is no expectation of privacy, but we're still mindful, and there's a protocol they have to go through before they can do any searches to make sure that they're not exceeding the scope. The other thing I want to mention about emails, again, has nothing to do with harassment, but deals more with the idea of the fact that we could be subject to Public Records Act requests. So as a reminder, I'll encourage all of you, to the extent you don't need to create a paper trail, don't create one. And if you do need to send something, be thoughtful about what you say in that email. If there is some kind of litigation going on, include counsel, and maybe it'll be protected by the attorney-client privilege. So, you know, I know this is being taped, and I hope that doesn't encourage anybody, but I do want you all to be mindful about that, and I think it's very important, because, you know, these requests are frequent, and we've actually been pretty lucky that we've gotten them. Physical harassment, massage, hugs, and touching. Everybody has a different comfort level. I know some people think the pendulum swings too far, and maybe in some situations it has. But I'll mention the case out of Yolo County, where the Yolo County Sheriff was sued by a female deputy who claims he hugged her 150 times. He didn't hug the male deputies, and that case got past summary judgment, so there must have been enough facts there for the judge to say, yeah, there's something not quite right here.
Still ongoing?
Ongoing, I believe,
Oh.
yeah. Verbal harassment, sexual comments, ethnic jokes, mocking accent. This is another one that I used to pass over until I heard this comedian do a discussion about mocking accent. And any fans of The Simpsons besides me? So this comedian is an Indian American, not Native American, but an Indian American, and he's probably in his 30s now. And when The Simpsons came on, he was like 15 years old, and there's a character on The Simpsons named Apu. And back in the day, even to this day, there's just not many Indian American characters on TV. I mean, it's kind of easy to make fun of Homer or Bart or some of the other characters, but anyway, he talked about how horrible his middle school and high school years were because they just constantly made fun of his accent from this show. That's, by the way, voiced by a white guy.
So comedians, though, they're
well, he's a comedian himself, and he kind of used that as a kind of a jumping off point.
But I'm just saying, as a question, a separate question, comedians, how are they? I mean, all this doesn't. I mean, I guess this is just workplace, but it still seems like people could do stuff. I mean, if somebody was in the audience at a comedian show, could they sue the comedian for insulting them or?
It is a bit of apples and oranges. It's not an employer doing it.
So it's got to be an employee.
If they're Republicans, they get in trouble. If they're Democrats,
you're okay.
It's just you're a comedian, so it's okay. Roseanne Barr.
Yeah. Okay. But it's just saying everything that a comedian says is inappropriate for. I mean, that's why people.
Most things it's a different context.
Yeah. Okay.
You can leave and not get fired.
Yeah, that's true.
What about
Walk out and
people's
not
free speech? I mean, where's the pendulum go in terms of what I may say, and one person in a room of 50 people finds that offensive?
Well, it depends.
And that just because they find it offensive, I mean, get into comedians. It's just tough luck. Other people have the right to say.
So if you're a stand-up comedian, it's one thing. If you're sitting on a bus, it's another. But if you're an employee of a company, it's going to be a different test and a different standard because you're in a different situation.
You have a captive person that you're saying things that are offensive, but that's a really ticklish area,
Well, not so much with a coworker, but with a supervisor, there's a power difference.
Right.
So that is part of the equation.
And you're a board member, so you're real powerful.
Right?
I hear the hostile work environment term, I think overused.
What did you say?
The hostile work environment term, I think is overused because it's misunderstood.
Right.
So, because they think if somebody's, they don't get along just personally, that they're in this hostile work environment because they don't get along.
Like they have an abrasive personality.
Yeah. Can you get into that a little further and also
Sure, so let me go back to that slide.
I don't know if you're going to talk about bullying.
We have never had anyone hostile on this board.
So,
Nope.
You weren't here.
I watched.
So hostile work environment doesn't mean hostile in the legal in the literal sense. Remember the Supreme Court case defined sexual harassment in this hostile work environment theory. So this is the legal test called hostile work environment sexual harassment. Of course, it could be any kind of harassment. For somebody to get money damages from their employer, right? Physical, verbal, or visual behavior of a sexual nature, objectively and subjectively offensive, severe, or pervasive. That's the legal test for money damages. The hostile work environment disciplinary test, the only difference is it doesn't have to be severe, pervasive, and it could be welcome. It's just not appropriate in the workplace. And it couldn't be anything from some type of verbal counseling to possibly termination. So,
But it's a sexual harassment nature.
or of some type, some protected classification.
class.
Right. It's not. And it's not bullying, which actually is the slide I'll be talking about, or aggressive, mean behavior. That's not a protected classification, but still not appropriate, right, in the workplace. In fact, that's another piece that the legislature has said needs to be included in this training, and I'll have a slide on it. It's not making it illegal, but it's saying that nobody should have to put up with an abusive supervisor who yells at them or does any kind of other physically threatening kinds of behaviors. Gray borderline areas, consensual relationships, we talked about that. You can still ask somebody out on a date. If you ask them 33 times and 32 times that before that they said no, you know, obviously you're crossing the line, but, and the other things we've already talked about. So if a situation occurs, we kind of already talked about this too, in a perfect world, if everybody had a certain kind of a comfort level, you just tell the person, hey, you know, it really bothers me when you say that. Some people are comfortable doing that, some people aren't. I have found, I think, I've seen that when people hear that it's bothering them, that it's bothering somebody, that they're kind of surprised and they stop and it goes away. But there's other places you can report it to within your employer, and as I mentioned, to the DFEH if it's appropriate, if it's significant enough, maybe an investigation will be conducted. So about 10, 15 years ago, both the US Supreme Court and California Supreme Court came up with these legal tests for harassment. And they're different depending on whether the supervisor is doing the harassing or its coworkers. And as Catherine just mentioned, because supervisors have kind of this inherent power over employees, and from a legal standpoint, when a supervisor is doing the harassing, it's kind of the courts consider it like an agency relationship, and it's almost as if the employer itself is doing the harassing. So the test is it's a strict liability. It's like an automatically liable, but there is a defense. If it's coworkers, the employer is only going to be liable if a supervisor or manager knew or should have known about it. So I'll talk about that and explain that. And this gets to the question that somebody had asked earlier, I think it was Dan, about who's a supervisor. And it is broader than someone who just prepares someone's evaluation. If they direct their daily work, they can be considered a supervisor. And if so, and they're the ones doing the harassing, it's a strict liability test. And the courts have said that an employer is going to be automatically liable for harassment unless the employer can show this, prove up this defense. First, that there was no adverse employment action taken. So you don't transfer the person who made the complaint. Remember this whole idea of second set of facts? That's why that's so important, because it will help you prove up this defense. The second part of the test is that the employer has a discrimination policy in place and provides training. That's pretty easy to satisfy. And that you look into the matter. And that's pretty easy to satisfy too. And if the allegations are sustained, meaning it's more likely than not that the investigator finds that the conduct occurred, that you take appropriate action. The last part of the test, the courts put some responsibility on the shoulders of the person making the complaint to come forward in a timely way. And if they don't come forward in a timely way, then that, you know, can be a defense to the employer. And the employer needs to be able to show that if they knew about it, they would have taken appropriate action. And the way you can do that is to show what you've done in past cases. Harassment between coworkers, again, is this newer should have known test. And, you know, how do you know? You just need to be proactive. Reports of harassment to supervisors, it could be by someone other than the victim. Sometimes you might get a request, hey, I just want you to know this has happened, but I don't want you to do anything. The law is very clear that once an employer is on notice, there is an obligation to take whatever action is appropriate to investigate and find out what's going on. Responsibilities of supervisors, pretty straightforward: advise, cooperate, you know, don't harass yourself. The discrimination complaint process. So if it's kind of not a serious issue involving maybe some serious touching or worse, maybe it's just some verbal counseling. It may not need to be investigated. You're still going to want to have a good paper trail to show that, you know, you looked into it and took whatever action was appropriate under the circumstances. If it is more serious, the county of Sonoma at least has an EEO manager. I assume there's some division of human resources that you don't want departments investigating itself and there's a complaint of discrimination. You want it to be someone with expertise and also somebody who doesn't have bias. So that's the role of an investigator, is to be a neutral fact finder. So we have a couple of folks who do these investigations. Sometimes we contract with an outside attorney depending on workload or depending on the parties involved or the seriousness of the allegations. And the investigator will make a report with findings, a conclusion, and a recommendation. So findings are, for each allegation, does that investigator think that it's more likely than not that the conduct occurred? If those are the findings, then the conclusion is probably going to be that the county's policy was violated. Again, you don't want to make a finding of sexual harassment. That's for a jury to decide. And the recommendation in most cases will be leave it to the department head's discretion to figure out what the appropriate level of discipline is. I will share that in a number of cases over the years, the recommendation has been, because the allegations were so egregious, to terminate the employee. And in all those cases, the department head did do that. Yeah.
Here's a question. What liability does the employer have if you're saying the action, the disciplinary action is being left to the department head? And the reason why I'm asking that is because going back 25 plus years at university, I was on a selection committee, and our recommendation to an administrator was, this is our your best applicant. So the person, second runner-up, is pretty far down there. And it was later determined that he contacted the runner-up and asked him to withdraw because the top applicant was a woman. And that became known to the university, and then like the next year he was working somewhere else. That administrator left. But I'm just saying, if you had an administrator who wasn't abiding by the law, and if you're leaving it to that administrator to implement the disciplinary action,
right,
is the employer responsible?
Yes, and so hopefully HR and county council were also working on that case, and if they feel that a department head is going rogue, then it's really incumbent upon them maybe to get the CAO's office involved, and maybe schedule a closed session with the board. I mean, then it, hopefully the team approach ends up making sure the right thing happens. So findings, conclusions, recommendation. Documentation supervisors can gather. I mean, it's classic who, what, where, why. The reference to contextual information is sometimes there's a backstory, maybe there's something else going on. Personal liability, both supervisors and non-supervisors can be personally liable. We talked about that in the pre-test. This next bullet point, if the Board of Supervisors finds your conduct to be outside the course and scope of employment, the board may decide to not defend or indemnify you. So let me explain this. So outside the course and scope of employment is a legal term, and it means you've engaged in some pretty outrageous, extreme behavior. And so if there's a situation where an individual employee is sued, as well as the county, the Board of Supervisors will meet in closed session, talk about the case, hear from their attorneys, and if they feel that the conduct is as I've described, they could decide to not defend, meaning provide that person with counsel, or indemnify them, meaning reimburse them if they're hit with a money damages award. And I'm recognizing I'm being taped, but I say this in all my trainings, and I've been in the county counsel's office for a long time, and there's really very, very few cases that's ever happened, and I don't get into the specifics, but nobody would disagree with the facts in those cases, that in those unique, rare circumstances that they weren't given a defense or indemnified, and I don't think anybody in this room would disagree. So it's very rare, and I wouldn't want Mendocino County employees or any county employees to think that their employer wouldn't stand behind them, but in rare circumstances, it's justified. Prevention, report all complaints as soon as possible, take them seriously, be a good role model. If there's no protected classification involved, maybe there's some kind of mediation or EAP, what's going on, maybe there's something that needs to be addressed. Bullying, so I kind of talked about this earlier, that the legislature wanted there to be some discussion about this in the training, and they defined abusive conduct in the legislation as conduct by an employee at work with malice, meaning intent, intentional behavior, that a reasonable person would find hostile, offensive, unrelated to an employer's legitimate business interests. So you can see it there, derogatory remarks, insults, physically threatening, intimidating behavior.
So if you sit on a board and someone on that board engaged in that kind of behavior, is there recourse?
Well, it depends on the kind of board and how that person got there. So it depends, I'll leave it at that.
Okay.
Key takeaways, don't ignore the issues, documentation, and 2 sets of facts. The post-test, the investigator's role as a neutral fact finder, don't ignore complaints of discrimination. Yes, you need to be concerned about any kind of conduct, whether it rises to the level of illegal discrimination or it's a lower level verbal counseling kind of thing. Number 4 is just getting at the county's discrimination policy. Number 5, yes, you can be personally liable for harassing a coworker, that's true. Number 6, if the conduct occurs away from the workplace, it can't be harassment. I'm reminded of that Mokler case, and one of the things in there was that one of the incidents occurred while Mokler was at a party for a newly elected member of the Board of Supervisors. And she was one below a department head, so I think it was pretty expected that she would go to this quasi-work-related function. And the court seemed to say that the incident that occurred there didn't occur at work. I really frankly think they got it wrong. I think that is a work nexus. It's almost like being in a training. Anyway, if the conduct occurs away from the workplace, it can't be harassment or discrimination. Kind of depends on the facts, but I think absolutely it can be and really was in that Mokler situation. Number 7, if a manager should have known that one of her staff was sexually harassing a coworker, the county could be liable, that's true. Number 8, during a break at a board meeting, the retirement administrator, staff, and a few trustees are chatting. One person makes an off-color joke. What, if anything, should James do?
Well, maybe it was him that made the joke.
So I'm not going to put anybody on the spot. And, I really do want to encourage people if they feel that something is inappropriate, and they don't have to do it to embarrass anybody in front of other people, but if you're comfortable, tell somebody about it. And, I don't think you should have to ignore anything that makes you uncomfortable.
Jeff, if I can, I'll jump in there. I've had plenty of opportunities over the years where I've encountered someone and they've used a word that I personally find very offensive because of my personal background and experience, and it's commonly known as the R word. And if you don't know what it is, just ask the person next to you.
Blank.
And it has to do with mental capacity.
Oh, okay.
And
I thought you meant Republican.
Oh, one and the same, right?
Protected class.
and it's a very offensive word to me.
Yeah.
And anytime I encounter that word, I always have a one-on-one conversation after the fact and let them know that that's offensive. I don't want to call people out in a group and make a scene.
Right.
I think it's a much more effective thing to say one-on-one, you use this word and that's offensive to me and I'd like for you to not use it, not just in front of me, but not ever, because it is offensive to a lot of people.
That's a good
So,
point, yeah.
Mm-hmm. I also think that a lot of people don't have a negative reaction to that because it's like, oh, I didn't realize or something. There are a lot of words that are offensive to people, and you're just being honest and raising their awareness is
Right.
maybe they're appreciated.
Yeah.
But that brings up a good point. I mean, the F word is offensive to me, but everybody uses it around me.
Yeah.
Like, stop everybody and tell them we don't like
Yeah,
it. I mean, gosh.
yeah. I think, yeah.
I'm with you on that one. Occasionally use it myself.
Like when you fell.
Dialogue and education is a good thing,
Yeah.
as much as possible.
So number 9 is a long one, but I like to share it because it allows me to talk about Detroit where I grew up. So Don and Sharon are interviewing for a new manager at a retail store. The store is located in a bad neighborhood. When I get to bad neighborhood, I always think about how my kids went to this elementary school right by our house that's a very sheltered, kind of safe elementary school called Hidden Valley. And the natural feeder school is Santa Rosa Middle. And you probably aren't going to be too familiar with it, but it's close to the downtown, and there are some people who think it's an urban school. And I'm not saying that there aren't some parts of Santa Rosa that aren't dangerous, but I grew up in Detroit, and it's way different. So everybody has a different perception. I don't know if any of you ever saw 8 Mile. I grew up at 8.5 Mile. Anyway, so the relevant part is coming up. What if she gets mugged? Don also expresses concern that some customers might use rough language that might offend a female manager. Don and Sharon's boss intervenes, saying he doesn't think gender should be a factor in the hiring decision. Sharon and Don's behavior is appropriate, concerned about safety, inappropriate, making assumptions based on gender, sexual harassment, or sex discrimination. What do you guys think?
B.
B like boy? Yeah, I mean, I think it could be D if they actually made the decision. So remember I talked about essential functions worksheets? I mean, you can tell somebody what the job is like and that there may be some issues, and then it's up to them to decide if they feel that they're comfortable with it or not. That's the point of that question.
She's got a black belt in karate.
She packs heat.
Yeah.
Last question. The number one reason most people file harassment or discrimination complaints: A, money; B, revenge; C, to cover up poor work performance; D, none of the above. I really do think that it's none of the above, and they just want the behavior to stop. I'm not saying there aren't some people out there who are trying to win the lottery, but
Yeah, as an employer, it's the number 2 issue. It's the big concern. I mean, you look at all this. It's all rightfully well intended to protect employees from harassment and being put in unpleasant situations that they have no control over. But man, if you're an employer, it takes 9 months to fire just a lousy employee. Just because you got to go through all these hoops that this creates, because if you don't, then they can just pull one of these cards out of the deck, and it's $50,000 to take a case to court. So, it's a lot easier to just pay some employer, oh, well, I'll take $25,000 if I go away. So, I mean, the legislature is just, everybody's a protected class but employers.
7 years to
well, I guess
fire
that's where we're going to
teachers.
leave it for today.
Tenured teacher, 7 years,
Oh, to fire one?
if you can.
Unless anybody has any questions, you're free to go.
Thank you. That wasn't as painful as I was afraid it was going to be.
Meeting adjourned.
Meeting adjourned? Meeting adjourned.
The teacher was great.
Yes. Yes.
At 1:19, we are adjourned, Madam Chair?
Yes.
So be it. We are adjourned.
Thanks, Jeff.
Okay, 'cause I'm on there.